Finance this Wednesday, January 29th. I'm Julie Hyman, that's Josh Lipton, and we are moments away from the Fed's decision on interest rates. If you look at markets right now, not a whole lot of change, a little bit of bias to the downside ahead of the decision, which we pretty much know will not be any change to rates. But the press conference is going to be really interesting today. Right now, we're seeing the Dow lower by about 70 points, the S&P off by 0.5%, the Nasdaq continuing some turbulence this week, down 0.8%.
Yeah, Fed has well telegraphed a pause, Julie, and the thinking there seems to be, well, that could make sense, of course, because Jay Powell and the team, they know there's so much uncertainty about the range of issues we talk about in Yahoo Finance all the time, but taxes and trade and immigration, tariffs. Why not take a pause? Why not wait to see maybe you see the dust settle here? Although the other side of that, which I'll hear some economists say, is if that's the thinking, you're taking a pause because you're hoping the dust to settle. How much dust really settles between now and the next Fed meeting? How much certainty are you really going to get in about 6 weeks?
Well, but the backdrop also is that some inflation indications were reaccelerating. Then we got some that were sort of not, showing some disinflationary tendencies. So, even if you look at just that backdrop, excluding the effects of any kind of potential fiscal policy changes, that also is not necessarily providing an unambiguous direction about where the Fed should be going.
So what do you think reporters grill him on in the presser? What's the topics?
Trump, Trump, and Trump.
And how much does he give them on that?
Nothing. I guess we're trying to make a little suspense here. I don't know that there's a lot of suspense about that. He is going to endeavor to say nothing. I think that much is clear. There are some rotations, by the way, in the voting members of the Fed here in 2025. So that could be interesting about whether we get to sense and what we learn behind the surface or underneath the surface. All right, the Fed's decision's out. Let's get to Jennifer Schonberger.
No change. The Federal Reserve holding rates steady in the range of 4.25% to 4.5%, marking the first pause since the Federal Reserve initiated 3 consecutive rate cuts last fall. Officials removing language from the statement that they see progress towards their inflation goal of 2%, only retaining language that, quote, inflation remains somewhat elevated. This, of course, as policymakers remain cautious on the direction of inflation. Now, policymakers did acknowledge improvement in the job market, noting that the unemployment rate has, quote, stabilized at a low level in recent months. That's a change from previously saying that the job market had eased. Officials characterized labor market conditions as, quote, solid. Now, policymakers also retained key language in the statement that, quote, in considering the extent and timing of additional adjustments to the target rate, that the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Again, just showing a higher bar for future rate cuts versus what we saw earlier in the rate cutting cycle of 2024. This decision was unanimous. Back to you.
So that is interesting on that last point, right? We were just talking about some of the changes on the FOMC. Thanks, Jen, appreciate it. Let's talk about what we are seeing in the markets here as we get this announcement. Again, we weren't seeing much change before, but we are seeing a little bit of a leg downward, actually. Our Josh Schaefer is taking a look at the news here and its effect on the markets. Let's go over to him. Josh?
Hey, Julia. So you mentioned a little bit of a leg lower here. So if I circle right where we're at right at 2 p.m., markets moved a little bit lower. So you got the Dow off a little bit over 0.3%, the Nasdaq off about 0.9%, but you can see you're already starting to get a little bit of a bounce there, and the S&P 500 is down 0.6%. Now, guys, of course, we know once 2:30 comes and Chair Powell starts talking, that's usually when you're going to see most of the market moves on a Fed day. I'll check a couple other key parameters I'm going to be watching throughout the press conference here just to sort of give us some levels before we head into that presser. So the 10-year T-note, of course, has been a big story over the month of January. We're sitting at 4.56 right now. That's one of the lower levels we've seen in the past month overall. Of course, this chug higher here was a headwind for stocks. So anything that Chair Powell says that could move the 10-year higher could be trouble for stocks. Similarly, let's take a look at the U.S. dollar index. The U.S. dollar index sitting at 107, again, at one of its lower levels of the last month. Anything that Powell says in regards to tariffs and inflation could be a mover in the dollar. Again, as the dollar gets higher near the levels we saw here, that's been a key headwind for stocks. One final thing, guys, I want to leave you with. I'm going to flip over to our heat map here and just sort of point out It's a different Fed day today. There's a lot of news going on right now, and I want to highlight the big one, Nvidia. So a report coming out of Bloomberg saying that Nvidia may be facing more restrictions from the Trump administration on its sales to China. Nvidia hitting its lows of the day, down 6%. Of course, we have several big tech earnings after the bell as well. So a little bit of a different Fed day driving market action. We'll see if Jay Powell can take the driver's seat as we get to 2:30.
All right, thank you, Josh. And here with more on the Fed's decision to hold rates steady, we have Kevin Gordon, Charles Schwab Senior Investment Strategist, and Kelsey Barrow, JP Morgan Asset Management Fixed Income Portfolio Manager. Welcome to you both. Kevin, I will start with you. So you get this, it's a unanimous hold here, Kevin. Stocks fall, yields climb. Give me the instant Kevin reaction and response.
Well, the market reaction is tough to parse out a little bit because I think we're still feeling the effects or dealing with the effects from what happened on Monday. Because Monday and Tuesday were total opposites, where on Monday you had the market up, the indexes were, market down, breadth up. Opposite on Tuesday, a little bit of an opposite again today. So it's hard to take the instant reaction and say that it's directly related to what the Fed decision was. I will say, though, I think that when we get the statement from, or the presser from Powell and the details from it, I think what will be really interesting is to see, to your point about dissents, the ending of that decision in that statement, what dissents look like for the rest of the year. And if there's starting to be maybe more of a splitting as to how certain members view potential impacts from policy, especially as it pertains to tariffs and immigration, because we know that Powell's probably going to be pressed a lot more on that. He basically opened the door for that in December when he started discussing it a little bit more, saying that certain members had started to factor that into their scenario analysis. So to me, I think that's probably where more of the important signal is. I wouldn't take the market reaction today as any sort of signal, mainly because of what has predated this, in terms of what happened on Monday.
Well, and I would go back to my earlier point, which is that, okay, let's also take a look at the backdrop, even excluding the effects of fiscal policy, because what's important here is that the statement doesn't have any reference to ongoing progress to the 2% inflation target, that, quote, inflation remains somewhat elevated. So, Kelsey, how do you read that kind of change in language?
So I think they've seen enough inflation progress to get them to where they are today. So they've already cut rates 100 basis points, and they've put themselves in a fairly good position where now they're trying to balance both keeping the labor market strong, but making sure that inflation stays under wraps. Now, I do think that the disinflationary trends that we're seeing are still persisting. It's never a straight line when it comes to the monthly CPI prints or the monthly PCE prints. But if I take a step back and I look at what we are expecting in the PCE report on Friday, so that's the Fed's preferred measure of inflation, we're looking at a run rate for core PCE on a 3-month or 6-month basis, right around 2.2, 2.3%. So yes, still above the Fed's target, but not miles away. And so what I'm looking for in the press conference, what I want to hear from Chair Powell is, we've cut 100 basis points, but inflation's still above target. Is this current policy level, 4.25 to 4.5, do they still believe that's restrictive? That's really the key question that I want to know a little bit more about and how he's thinking about it.
The other key question, I think Kelsey nails the first one, such a big part of the issue here. The other one, Kevin, is just how they see the economy evolving here. What's interesting is how they describe the economy as being solid, right? That this is what we do. We start to read the tea leaves way into it. Is that, in your opinion, is that policymakers signaling, hey, economy's solid, that's not an economy that needs a cut?
Yeah, and if they're holding for or pausing for the reason being that the economy's fine and that GDP growth is still solid, that's fine. It takes a little bit longer, I think, to get that message through, probably because you don't want to make it seem as if you're spooked by inflation, and that's the thing that's keeping you solely from being able to move in either direction. I do think, though, that to Kelsey's point about a strong labor market, what I'm actually looking for now is language stemming from maybe a realization that if the labor market for some reason is going to retighten a little bit, which is not our base case, but if they do see any signs of that, does that lead to any kind of inflation? Because a lot of the rhetoric from the Fed over the past 6 months has been that they don't see any inflation pressure, meaningful inflation pressure coming from labor. And that was evident in the JOLTS report that we got most recently and the jobs report we got most recently, where hiring rates are still low, wage growth is still relatively solid. solid in terms of its disinflationary trend. But if that for some reason stabilizes or starts to reverse a little bit as the economy continues to hum along, then that puts into question what they view actually as restrictive. So then they sort of have to kind of reassess what the correct level is going to be. But again, then you get into a tougher scenario where if they do have to pause for longer or potentially hike down the road, but that's because the economy is doing fine, then that's a little bit of a tougher scenario to digest for stocks, I think.
I mean, they also, on the labor front, they said in this statement the unemployment rate has stabilized at a low level and labor market conditions remain solid. So that seems pretty confident. Kevin, I want to stick with you for a minute because as Josh Schaefer reminded us a few moments ago, the Fed ain't the only game in town, right? We've got fiscal policy that the market is considering as well. And we got DeepSeek out there, as you talked about earlier in the week, hitting tech stocks. We have large cap tech earnings. How are investors, equity investors in particular, even weighing the Fed at this point?
It's interesting. I was sort of kind of joking with some colleagues the other day or yesterday, actually, that nobody's really talking about the Fed. Monetary policy has really taken a back seat here. But I think because of how important this earnings season has become from a Capex perspective for some of the mega cap tech names or tech adjacent names, and because of the news that came out on Monday, and then you throw in everything that's happening from a Washington policy standpoint, I think that's become more of a dominant narrative now. But eventually that makes its way into monetary policy because even for Washington things in particular, I mean, that's probably going to be addressed right out of the gate, I would assume, in the press conference today. The trouble with that, though, is that there is no instant gratification for investors because, number one, Powell will probably brush it off a little bit. Number two, the impacts that you have from tariffs or from immigration take a long time to feed through to the economy and then take even longer, I think, to feed through to monetary policy.
I'm interested, Kelsey, when you're talking to your clients right now, what is sort of top of mind for them? Do they bring up Trump more? Is it Powell more?
I would say the focus is probably on the fiscal policy. And then there's that interaction or that feedback loop in terms of how does monetary policy react. So I think the biggest uncertainty with tariffs is what's more important. Is it the negative growth impact or potential negative growth impact, or is it the inflation impact? Because the negative growth impact would tell you that the Fed needs to ease policy in response to tariffs. The positive inflation impact would tell you that the Fed needs to hike policy to protect inflation. So where do they sit in the middle? Now, I think it's interesting. The Bank of Canada was out earlier today. They had a rate decision. They actually cut 25 basis points to 3%. And they were much more leaning into the negative growth impacts and making sure that they keep the economy going. So what I want to know is, are we going to be more like the Bank of Canada in terms of our response, or are we going to be more focused on the fact that inflation is still above target and maybe we don't have the leeway to respond like we did in 2019 when we had a trade war. There was a ramp up of tariffs in 2019, tension between US and China, and the Fed actually cut that year and in response to slowing global manufacturing.
I also have to wonder, we've been talking all about tariffs and immigration. Oh, what about, if people are furloughed from government jobs, right?
Right.
Are we also, so does that then tilt the concern more towards growth if you really do see this reduction in government jobs and government spending and that make its way through the economy?
So the Fed is unique to other central banks because they have a dual mandate. They're not just concerned about inflation, but they're also very concerned about the labor market. And while the labor market has been strong, job gains have been very concentrated in just a few sectors: healthcare, leisure and hospitality, and government. And so while federal government is a smaller portion of hiring, state and local is actually the larger part. I am interested to see how hiring in the government sector evolves, because that has actually been an engine of job growth over the last few years that we may not be able to count on in the year ahead.
Same question to you, Kevin. I mean, I know the Fed just is describing the economy as solid, but there's plenty of economists who look ahead and I don't know how solid it remains, and they'll tick off any number of reasons. They'll say CEOs might get kind of more conservative with their investment, given all the fiscal policy uncertainty we're talking about, throwing in government as well that Julie's highlighting. How are you seeing it?
Well, that's one thing I find that's often missed in the narrative around tariff policy not leading to potentially any bump in the road for growth. I mean, when you go back to 2018, 2019, whether you're looking at a survey-based metric like ISM manufacturing, whether you're looking at hard data like business capex within the GDP data, both of those slowed materially from 2018 into 2019. And it was actually kind of before the pandemic came along, it was one of those metrics we were really keeping a close eye on as to whether it was going to signal that we were maybe going into, if not an outright recession, then some form of a growth recession. We'll never, of course, have the answer to that. But I think that it's probably worth looking more at the growth impact as opposed to the inflationary impact from tariffs, because regardless of what the percentage is, which countries have tariffs applied to them in terms of the goods being imported to the country, aside from all of that, the nature of this policymaking in terms of it could be on one day, off another, the 9-hour tariff war that we had with Colombia, and then it seemingly ended all at once. That nature of policymaking is what causes companies to maybe take a step back and halt their spending. So if you're a big corporate executive trying to make some massive capex spending plan and plan around this policy by post, it's really tough to do that. So that in and of itself creates more of a cloud or a mist of uncertainty, and it's harder for companies to operate in that environment. So I wouldn't be surprised if, a year from now, if we do have relatively aggressive tariff rates, being raised, wouldn't be surprised if you did see a little bit of a pullback in capex expectations. And you add on to the fact, which is different from 18 to 19, you add on to the fact that we have much stricter immigration policy being proposed.
Guys, thanks a lot. And I'm really excited because we get to talk to you again after
Great.
the Fed presser.
Awesome.
Kelsey, Kevin, really appreciate it. We'll talk to you again after Jay Powell's news conference. Turning now to a trending ticker, it is Nvidia, which is under pressure again. Our Josh Schaefer referred to this a moment ago. Shares down in today's trading, and actually pretty much the lows of the session here. Bloomberg reporting that Trump officials in the administration are reportedly exploring additional curbs on the sale of Nvidia chips to China. We do have a statement from Nvidia on this point. The company saying they're ready to work with the administration as it pursues its own approach to AI. The thresholds set by the Biden administration, says Nvidia, are based on performance levels reached 5 years ago and achieved by leading gaming and workstation products. So that's what we heard from the company, but the shares are down, Josh.
Yeah, and Bloomberg citing sources just as investors try to think through a potential timeline to the headline. Those sources emphasizing this is all very early stages. The decision is likely a long ways off, is how it's at least being described in the article. I mean, NVIDIA has lived under these restrictions, of course, for years in terms of what it can sell to China. But if you're an investor, you hear this, and certainly analysts are bringing out their models and trying to estimate, okay, what could be a top-line impact there?
Well, and just to be clear here, these reportedly, these new curbs that are being explored are on the chips that NVIDIA developed to get around the other curbs.
Right.
Exactly.
Yeah.
So these are the chips that they have been allowed to sell into China. We shall see what happens, and we'll keep you posted. Stick around. We've got more of Yahoo Finance's Fed Day coverage right on the other side. Don't go anywhere. The Fed has decided to hold rates steady at this month's FOMC meeting. For more, we want to welcome in Blarina Urici, T. Rowe Price Chief U.S. Economist. Blarina, it is good to see you here. So, first of all, I would just ask your reaction, not just to the fact that the Fed didn't change rates, we widely expected that, but to some of the tweaks in language here where they seem to be expressing a little bit more concern about inflation, even as they express less concern, seemingly, about the labor market.
I would agree with your characterization of the revisions in this statement. I would say they reflect the evolution of the data. If you recall, when the Fed started to cut interest rates in September of last year, it was very concerned about the slowing in employment growth and the increase in the unemployment rate. As it turns out, those concerns are not valid anymore. The unemployment rate has actually declined and it's stable at those very low levels. We've had a pickup in the pace of employment growth, and I would say even a broadening in employment growth beyond those three pillars where we've seen concentration in recent quarters. Also, the diffusion index data of the payroll series suggests some broadening in employment growth. So I think the statement really is marking to market to what has happened in the data. We had a CPI report for December that shows inflation pressures are not reaccelerating, even as the labor market is improving, but they're actually not showing further progress towards the Fed's 2% inflation target either. So it leaves the Fed in this situation where it's willing to be patient and wait and see for further progress in bringing inflation down, but it can't really afford to cut interest rates any longer, given the strength of the economy and given all the cross currents in terms of trade and fiscal policy that we're going to face this year.
Blarina, you mentioned the strength of the economy, and the Fed describes the economy. They use the word solid, Blarina. You know, in this presser, those reporters, they're going to try to get more information out of Jay Powell about how he sees the economy evolving over 2025. How do you see it?
So I would say that the Fed and Fed staff have been on the pessimistic side when it comes to the U.S. outlook. If you recall, in 2023, they were expecting a recession that didn't materialize. And so I think the Fed will always be a little cautious on the growth outlook. And of course, it believes that interest rates are restrictive. And for that reason, it thinks that growth is bound to slow down further from here. Now, given how the economy has responded to the high interest rates, I don't think we have a ton of evidence here that at least near term our star is that much lower and that the Fed needs to be in a rush to cut interest rates. There is simply no evidence that policy is all that restrictive. So when I'm looking at growth for this year, I expect the economy to bump along in the 2.5% growth range, and also for the unemployment rate to be stable. We're not seeing signs that companies are willing to let go workers. And of course, we have a hiring freeze in place in the federal government. But as your previous guest discussed, federal government employment has not been the driver of payroll growth in the economy over the last 2 years. It's been state and local. So I remain quite optimistic about the economy. I think we need not forget that 75% of the economy is the consumer. So long as the unemployment rate remains low and jobs are plentiful, I think the consumer will be out there spending. We also don't have a significant degree of leverage. So the higher interest rate have not been biting the consumer as much as you would have expected.
Blarina, just quickly, we have to wait for the next Fed meeting until March 18th, 19th. Can we extrapolate from the statement today that the Fed is not going to move at that meeting, or do you think that that's premature to say?
I think given the state of the economy and given the policy uncertainty, my baseline is that the Fed stays on hold for the first half of the year. I think the only option or scenario that I can envisage where they would want to cut interest rates either in March or May would be if we have a sudden rolling over of the labor market, if we have sudden increases in layoffs. but not in specific sectors, but more broadly within the economy. Barring that, I think it's safe to say that we probably won't see a rate change in March. And really the focus for the March meeting is going to be how is the summary of economic projections revised? What does the Fed think about the Fed of rates going forward and the path for the unemployment rate? And again, it's going to be a very tricky balance for the Fed because we will have lots of news headlines, but we may not have concrete policy implementation in terms of tariffs or in terms of fiscal by then.
Lorena, we shall see. Thank you so much for your time. Appreciate it. Let's get more now on how markets are reacting to the news. Let's get it out to Yahoo Finance's Alexandra Canal at the New York Stock Exchange. Hey, Ali.
Hi, Julie. Well, we're seeing stocks trade firmly in the red as investors await Jerome Powell to take the podium. We're seeing Nasdaq leading the declines there, down over 1%. That's followed by the S&P 500 down about 0.8%, and then the Dow Jones Industrial Average down roughly 0.5%. I also want to take a look at the 10-year yield. We saw a slight uptick on the heels of the decision. It's up around 3 basis points, trading just under 4.6%. But over the past month, we are seeing yields off about 0.9%. I also want to take a look at some of the sector action leading up to this press conference. We're seeing real estate in the red, down about 1.5%. XLK, the tech sector, same thing there. We are seeing consumer staples up on the day, along with communication services. So those sectors, ones to watch. Of course, when Jerome Powell takes a podium, he's going to have to answer quite a few questions when it comes to the outlook for rates through the end of the year. Can we expect more easing? There have been some rumblings that perhaps the Fed won't cut at all. Is that something that he's going to address along with Trump's policies, including potential tariffs, which could hit as soon as Saturday? Julie, Josh.
Thank you, Ali. For more reaction to the Fed's decision to hold rates steady, we're joined now by Jim Bullard, former St. Louis Fed president, and Dr. Samuel Allen, dean of the Mitch Daniels School of Business at Purdue University. Jim, it is always great to see you. So Fed leaves interest rates unchanged, Jim. Economy, they say, is solid, maybe sounding a bit more cautious, though, on inflation. Your take, Jim.
Yeah, I think this was exactly what markets were expecting, and I do think they updated just slightly to the most recent data with some changes in the statement, but really not too much going on here. I think they telegraphed for the last 90 days or so that the pace of cuts was probably going to slow down, and that's exactly what's happening here.
Jim, we had a bit of a switch in the FOMC this year as of 2025 here. So we have some new Fed presidents who are going to be voting, including Austin Goolsbee, Susan Collins, Alberto Musalem, and Jeffrey Schmid. Any kind of change, do you think, behind closed doors as a result of that? You know, I mean, this is a routine change, but just curious what your take on that is.
Yeah, I don't know. I've always felt that the voting didn't matter all that much. After you meet for a day and a half, you kind of throw in the towel and say, I'll go with the team here. I think there wasn't a lot to argue about here, probably. Right. So this is a case where it was relatively easy. Sometimes you do get these, points in time where you really do have a case to make on both sides, and you will get a couple of dissents that way. But it's a pretty collegial organization.
Jim, I know it's a bit maybe Monday morning quarterback, but I'm still interested to get your take. I'm curious. The Fed slashing its policy rate by 100 basis points, Jim, in that 3-month period starting in September. Was that the right call? Was it an overreaction? What's your take?
I think it was the right call. They had to recalibrate because they hit the peak policy rate in the summer of 2023. And right after that, inflation came down dramatically. Core PC inflation down, more than 200 basis points. That's a lot in that world. And so they had to recalibrate to a lower number for the policy rate, but it got jumbled up with other concerns about the labor market in July and August, which later turned out to be a little bit of a false signal. So it was a complicated communications pattern there, but nevertheless, I think it was the right move. And I actually think the committee's in great shape right now with where the policy rate is. They can be patient, let the inflation continue to come down, and then they've still got a couple of rate cuts in their pocket if they want to use them.
Jim, do you think, first of all, do you think that we are going to get any rate cuts this year? And what do you think is the probability, if there is any, of a potential rate hike?
Yeah, I don't think you'll get any cuts if inflation is sticky where it is right now. So if you continue to get 12-month core PC at 2.8%, and that goes on for another 6 months, I don't think the committee will be too happy about that. But the good news is what they can do in that circumstance is just keep the policy rate where it is and not do anything, because I think they're a little bit higher than it probably have to be for that amount of inflation. So they're in pretty good shape here. Would they raise the policy rate? Maybe. And there's a little bit of probability in financial markets on that scenario, but that would require inflation to core PC inflation to go sustainably higher. And then I think they might decide that they're not restrictive enough. But I think that's a fairly remote possibility right now, not the base case.
Jim, what is the neutral rate? The policy setting that neither stimulates nor restricts the economy for you, Jim? I mean, is it with 2, 3, 3.5? Where are you?
Well, the committee says it's 3.
And what do you think, Jim?
Still agreeing with that, Jim?
Yeah, but I think it's got a wide range around it, and you can see that in the dot plot, and that's fine. But they're definitely on the high side of even the highest of those. But I think the thing is, even if you think it's 3%, you probably need another 100 basis points at least to be sure that you're bringing inflation back down to target. So that puts you at 4% as where they should be right now, and they're definitely above that. So that's why I think there's a lot of agreement around the table that they're probably in pretty good shape now, and they can gradually reduce inflation this year. Real economy's been doing great. Labor markets are doing great, so they don't have to worry about that side right now.
As one strategist said ahead of this, no surprises is the goal of the Fed here. So we'll see if the presser meets that standard as well. Jim Bullard, thank you so much. Really appreciate your time.
Thanks a lot.
And we are awaiting Fed Chair Jay Powell and his press conference. And as I just mentioned, there is this perception that he's going to strive to not surprise the market. Julian Emanuel, our friend over at Evercore ISI, writing that today. If successful, he said, today's Fed meeting will be remembered as uneventful, with investors focusing on insights into the economic outlook. So we'll see if Jay Powell achieves that right now.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer-run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve. Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if any, does a president making these kind of remarks have on policy? Thank you.
3 questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated his demand to you?
I've had no contact.
Thank you.
Thanks.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we really look at the movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive, and for that reason, we're going to be focusing on seeing real progress on inflation, or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates, and would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance, and I'd say you look at the last couple of inflation readings and you see we don't overreact to two good readings or two bad readings, but nonetheless the last couple of readings have suggested more positive readings. So I think policy is well positioned.
Colby from the New York Times. Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market, and we just chose to shorten that sentence. Again, I mean, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much, and I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do, this is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Michael McKee.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those four areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder, and meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know, and so you're just on hold, waiting to see what comes down. It's a very large economy, and policy is affected at the margin, but we're going to wait and see.
If I can follow up, the idea that you feel that policy is restrictive suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you should hold?
We're looking. It's more the other. The way it works is we are looking at the data to guide us in what we should do, and that's what we do. And right now, we feel like we're in a very good place. Policy is well positioned. The economy's in quite a good place, actually, as well. And what we do expect is to see further progress on inflation, and as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster, we could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy, and so we feel like we don't need to be in a hurry to make any adjustments.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes in answer to your first question, but to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available, and as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Which is governing.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. Just to follow up on Steve's question, what reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
As I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks. and we use our tools to try to, given our best understanding, our best thinking, try to achieve our goals. That's what we do. That's always what we do. Don't look for us to do anything else. And that's, lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do, and people should have confidence in that, as I said a few minutes ago.
You've said that the Fed is in wait-and-see mode based on the policies that come out of this administration. Has the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see there are alternative simulations. So that's what they do. There'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they spark the policymakers to sort of think and understand about the uncertainties that surround this. So yes, the staff does that, and we're all well aware that the range of possibilities is always broad, and not just now but always. And it's hard to be open to just how broad the possibilities are for an economy. No one saw the pandemic coming, and it changed everything. So things happen, but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case. But you don't act until you see much more than we see now.
Katerina Saraiva, Bloomberg News. Last month you talked about a future rate cut as being pretty, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. We want to see, further progress on inflation. And, the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation, because that takes out the seasonality issues that may exist. And, we're just going to need to see that. We think we see the pathway for that to happen. One example, a key example, is that you now do see owner's equivalent rent and housing services, the way it's calculated for PCE. You see that coming down pretty steadily now, and that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, that then we seem to be set up for further progress. But being seen to set up for it is one thing, having it is another. So we're going to want to see further progress on inflation. Remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, how is that broadly? You said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. We look at, of course, a very broad range. So it starts with unemployment, with the unemployment rate, employment participation, wages, job quits, are people quitting, that kind of thing, the ratio of vacancies to unemployed. We look at all those things, and you put your finger though on it's a low hiring environment. So if you have a job, it's all good, but if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of a. Let's say that the unemployment, that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore. We do watch it extremely carefully. It's one of our 2 goal variables. But I'd say we watch those things quite carefully. But nonetheless, overall, look at the aggregate data in the labor market. The labor market does seem to be pretty stable and broadly in balance when you've got an unemployment rate that has been pretty stable now for a full half a year.
Edward.
Thank you. Thank you, Mr. Chairman. Edward Lawrence with Fox Business. On employment, you said there's a broad range of possibilities, but last September you said, quote, "We understand that there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise." Now that the flow of the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react?
So what's happening is that the flows across the border have decreased very significantly, and there's every reason to expect that to continue. But job creation has come down a bit too. So, if those two things come down together, that sort of can be a reason for the unemployment rate to stabilize. In other words, the break-even rate, as population growth slows, the break-even rate that you need in new jobs to make make jobs for workers declines as well. So that seems to be something about what's happening. You do see a very flat unemployment rate at a time when you've seen significant declines.
I want to ask you about Fed employment. I know that tax money is not used here, but Elon Musk alleges that the Fed is, quote, absurdly overstaffed. We've seen the executive branch push to reduce the federal workforce. I just want to get your reaction.
We run a very careful budget process. We're fully aware that we owe that to the public, and we believe we do that. I've got no further comment than that. Thanks.
Chris.
Chris Rugaber at Associated Press. President Trump has said he will lower inflation by reducing gas and energy costs. Do you see such costs as a particular driver of inflation, and would lowering them have a dramatic effect?
Chris, I'm not going to react or discuss anything that any elected politician might say. So I'll give you a mulligan.
Okay, thank you. Well, nearly 2 weeks ago, the Fed said it was withdrawing from the network for greening the financial system, even as we have significant wildfires in Los Angeles doing billions of dollars in damage. And of course, the NGFS, as you know, is a group to talk about how the financial system could address climate change. Many commentators did see the timing as political. Why did you leave that organization? Can you explain that decision?
Sure, I'd be glad to. So we considered this, really at length, and we did decide to withdraw from the NGFS. And really the reason is that the work that the NGFS does has broadened very significantly. Think about nature-related risks and biodiversity and things like that. In addition, the work of the NGFS is in significant part intended to, and this is a quote, mobilize mainstream finance to support the transition toward a sustainable economy. So we joined to get the benefit of understanding what other central banks were doing and seeing research and things like that. I think this is just way beyond any plausible mandate that you could attribute to the Fed. And so we have a quite narrow role, as I've said many times, and I think that the activities of the NGFS are not a good fit for the Fed, given our current mandate and authority. So, and I just think it was time to acknowledge that, this process dates back a couple of years. I made the decision to bring this to the board, some months ago. The process just took time to get here, and this is when we got it and voted on it. So, and I'm aware of how it can look, but it was really not driven by politics. It was driven by kind of the disconnect between the work of the NGFS and our mandate. Other central banks have different mandates and belong to the NGFS. We have no criticism of them, but it just isn't. It's not right for the Fed.
Andrew.
Thanks. Andrew Ackerman with the Washington Post. I'm wondering if you could talk more about what further progress would look like for consumers.
Well, 2% inflation down to 2% sustainably is what we're trying to achieve. We're somewhat above that, as you know, and we want to see serial readings that suggest that we're making further progress on inflation. That's what we want to see, and consumers will pick that up, of course, in the things that they buy at the grocery store or at the store.
The other thing I wanted to ask was just how far away you think you are from neutral.
Yeah, you can't know with any precision, of course, as I like to say, that you know the neutral rate by its works. So I think at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You can consult models, empirical models, theoretical models. You really have to just look out the window and see how your policy rate is affecting the economy. And I think we see that it's having meaningful effects in bringing inflation under control. It has helped bring the labor market into balance as well. So that's what we think. I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is. But not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria. Victoria Guido with Politico. So as a general matter, when it comes to executive orders and OMB memos, do those always apply to the Fed, sometimes, never, or do you just often voluntarily comply? What is the legality there?
So it's been our practice, as I mentioned, to work to align our policies to those that are mentioned in the executive orders, and I'm just going to leave it at that. As I mentioned, I'm not going to go any deeper than that or get into any deeper into this set of issues today.
Claire.
Claire Jones from the Financial Times. Two questions, if I may, on tariffs. Well, first of all, we've seen global trade wars before, notably in 2019, last time around, but then we were in a very different place on both inflation and growth. If we see tariffs of the same sort of magnitude that we got then, which I know is big if, what do you think might be different this time around? And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed need to see on tariffs before it was willing to take such a preemptive move? Thank you.
Sorry.
What sort of information would you need to see on tariffs? Would you need to see a strategy, actual implementation, actual movement of inflation expectations before you're actually willing to change the path of monetary policy on the basis of it?
Yeah, so first of all, things are a little different now. We've just come through a high inflation period, and you can argue that both ways. You can say that companies have figured out that they do like to raise prices, but we also hear a lot from companies these days that consumers have really had it with price increases, and so I don't know how that shakes out. Nonetheless, you're coming through a situation where we're not quite back to 2%, and that's just different. In addition, the trade, the kind of footprint of trade has changed a lot as trade is now spread around. It's not as concentrated in China as it was. There's a lot more manufacturing. It moved to Mexico and other places. So there are differences, and I just think the range of possibilities is very, very wide. We just don't know, and I don't want to start speculating, as tempting as it is, because we really don't know. And we didn't know, by the way, in 2018. Yeah, we didn't really know, and the range of possibilities very, very wide. We don't know what's going to be tariffed. We don't know for how long or how much, what countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. There are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer. Just so many variables. So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter. And then we'll just have to see how it goes.
Courtney.
Thank you. Courtney Brown from Axios. Two unrelated questions. The first is whether or not there was any discussion about QT and the timeline for ending QT at this meeting. And then the second question is just, I wonder if the AI-prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
So let's talk about runoff. So the most recent data do suggest that reserves are still abundant. Reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant. We do intend to reduce the size of our balance sheet to a level that's consistent with implementing monetary policy efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I don't have anything to say to you about particular dates. It's just that's the process, and what we see is that rates do appear to be abundant. As always, we stand ready to take appropriate action to support that smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although, of course, we're all watching it with interest.
Simon Urbanovich with The Economist. Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point back above 7%. I'm wondering, kind of looking forward, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and it's long rates that matter for housing. So, I don't think I think these higher rates are going to they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So, we control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress, but we think our as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis, although we'd love to see that, of course, and we will.
And separate question for you on tariffs. Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
I want to avoid commenting even indirectly on the conduct of tariffs. It's not our job, and it's our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, we found in 2018 there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter for businesses making investment decisions and things like that. That's not something I'm observing today. It's very early days for this, but I think that did matter in 2018-19, and it's one of many things we'll be watching.
Matt. Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market, how concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
So we look at, from a financial stability perspective, at asset prices generally, along with things like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things asset prices are. And yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI. But we look at that. But, you know, we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective, and we think that there's a lot of resilience out there. Banks have high capital, and households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions with higher rates. So overall, financial conditions are probably still somewhat accommodative, but it's a mixed bag.
Richard.
Hi, Chair Powell. I'm Richard Escobedo with CBS News. One question for you. This month's statement notes that unemployment has stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier, one is that there's a low hiring rate. And so that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure. And in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs. And really, it's high inflation for the basics of life. It's not so much the inflation now, it's the price level, because inflation has raised prices. Inflation is now much closer to target, but people are really feeling that. But, overall, this is a good labor market. You're at 4.1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much slower population growth.
One more question. Some of the uncertainty around immigration policy is, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
We hear anecdotal reports, but I don't see. There's nothing in the data yet on that. But you hear that kind of thing about construction, for example, and businesses that are dependent on immigrant labor are saying that it's suddenly gotten harder to get people. But I know you don't see that in the aggregate data yet. But yes, you hear it anecdotally.
Nick.
Thank you, Chair Powell. Nicholas Jasinski from Barron's. The uncertainty is certainly a theme today, and I'm wondering, are there any periods from your career, or as it relates to markets, the economy, what's going on here in Washington and beyond, or from lessons from history that may provide some guidance for a central banker operating in uncertain times like today?
I guess I'd say this. Uncertainty is with us all the time. It is human nature, apparently, to underestimate how fat the tails are in a way. The possibility, we think of things in a normal distribution, and in the economy, it's not a normal distribution. The tails are very fat, meaning things can happen way out of your expectations. It's never not that way. I wouldn't, if you think about it, think about the first few months of the pandemic. That was uncertainty. Are we going to be able to reopen the economy? If so, when? How much of it? How long will it take? that was uncertainty. What we have now is a good labor market. We have the economy growing at 2 to 2.5%. Inflation's come down to now the headline inflation number was 2.6, and that's what the public experiences. We look at core because it's a better indicator of future inflation. So yes, the price level went up a lot for inflation, and people are feeling that, and they're not wrong. But so the kind of uncertainty we have is just a usual level of uncertainty about the economy, but then policies which are not for us to criticize or praise, really. Those are policies which people have been elected to implement. They're implementing them with a view to making a better economy. And so I wouldn't call this out as one of those times. I wouldn't compare it to the global financial crisis or anything like that, given that we have actually a very good economy right now.
Evan Reiser with Market News International. Chair Powell, is a March cut still on the table? And then additionally, are you looking to see better than expected data on inflation to cut, or are you looking for inflation data that roughly aligns with current forecasts?
So as I mentioned, the economy's strong, the labor market's solid, downside risks to the labor market appear to have abated, and we think disinflation continues on a slow and sometimes bumpy path. That tells me, and the other members of the committee, the broad sense of the committee actually is that we don't need to be in a hurry to adjust our policy stance. Your second question was?
Whether or not you need to see better than expected inflation data, or just inflation data that roughly aligns with your current forecasts?
It's one of those things we'll know it when we see it, but more the expectation is that we will make continued progress. And that's what we want. We'll know it when we see it. It's going to have to be something that isn't just idiosyncratic. You're going to want to see, continued progress with housing services inflation. You're going to want to see inflation behaving in a way that builds confidence that we are really making progress. That's what it's going to be. And I mean, is that better than our expectations? We expect to see that. It's just a question of when.
Hi, Chair Powell. Scott Horsley from NPR. In your 5-year review, you said the 2% inflation target won't be on the table. Can you talk a little bit about why? Is that because you think that's the right target, or is it because you don't want to move the goalpost mid-game, or what's behind that?
I think that goal has served us well over a long period of time. It's also the sort of global standard. I think that if a central bank wanted to look at changing that, you wouldn't do it at a time when you're not meeting it anyway. I would not look at changing it anyway, but I certainly wouldn't look at it at a time when you're not meeting it. I mean, there's just no interest at all in changing it. If I'm being at all unclear, we're not going to change the inflation goal anytime soon.
And 5 years ago, if I can paraphrase what y'all decided, it was you're going to not raise interest rates preemptively to head off inflation until you see sort of the whites of the eyes of inflation, because the solid labor market was so beneficial. Have the last few years changed your thinking about that?
So what we really said was that we wouldn't look at a strong labor market and raise rates unless we saw some evidence of inflation. So the thought was that we'd seen really low levels of unemployment with no sign of inflation. So why would you preemptively want to put people out of work in the absence of any kind of any evidence that suggested that this was not a sustainable level? It was a way of acknowledging how much humility we have about the starred variables, especially U-star, the natural rate of unemployment. So that was an insight. We'll discuss that again. That'll be one of the many things that we discuss. But I don't think that insight is wrong. We didn't, we said what we said was that, at times when inflation persistently undershot 2%, we would likely allow inflation to run moderately above 2% for some time. That's what we said. that turned out not to be relevant to what actually happened. There was nothing moderate about the overshoot. It was an exogenous event. It was the pandemic, and it happened. And our framework permitted us to act quite vigorously, and we did once we decided that that's what we should do. The framework had really nothing to do with the decision to. We looked at the inflation as transitory. And right up to the point where the data turned against that. And when the data turned against that in late 21, we changed our view and we raised rates a lot. And here we are at 4.1% unemployment and inflation way down. But the framework was more irrelevant than anything else. That part of it was irrelevant. The rest of the framework worked just fine as we used it, as it supported what we did to bring inflation down.
Let's go to Mark for the last question.
Hello, Chairman Powell. Mark Hamrick with Bankrate. As you know, in the annual report from the Financial Stability Oversight Council, among the risks outlined is cryptocurrency. Could you talk about those risks now? And regarding individuals and households, perhaps distinct from the concern about the financial system, do you worry that speculation in this unregulated asset class could hurt their financial well-being, or do you think it has a place in a household's portfolio?
So our role with Bitcoin really is to look at, with crypto, really is to look at the banks, and we think it's, banks are perfectly able to serve crypto customers as long as they understand and can manage the risks, and it's safe and soundness. A good number of our banks that we regulate and supervise do that. The threshold has been a little higher for banks engaging in crypto activities, and that's because they're so new, and we don't want to make the mistake. If you're making a choice to conduct that activity inside a bank, which is inside the federal safety net with deposit insurance, then you want to be pretty sure that it's a safe and sound activity. So, we're not against innovation, and we certainly don't want to take actions that would cause banks to terminate customers who are perfectly legal just because of excess risk aversion, maybe related to regulation and supervision. So.
And with respect to households and their inclusion in the asset class?
That's kind of it's not really our bailiwick. You want people to be knowledgeable about the financial engagements that they have, and that's why we have the securities laws that we have. It's why if you read a mutual fund prospectus or individual stock prospectus, you want households to have the chance to understand the risk that they're taking. And I do think it would be helpful if there were a greater regulatory apparatus around crypto, and I think that's something Congress was working on quite a lot. We've actually spent a lot of time with members of Congress working together with them on various things, and I think that would be a very constructive thing for Congress to do. Thank you.
That was Fed Chair Jerome Powell speaking following the latest decision by the FOMC to hold interest rates steady. And as we look at the markets here, we are seeing things kind of off the lows of the session following those comments. Not anything, but also not recovering substantially. We're still in the red for all three major averages. So nothing that he said spooked the markets more, like we saw in mid-December, but nothing cheered them up more than what we're seeing at the moment. Josh.
First question out of the gate. Trump.
Of course.
Yeah, of course. Powell said, listen, he's had no contact with President Trump since the president made headlines last week saying he would demand that interest rates drop. No contact. Kind of set the tone right out there, said I'm not going to have any response or comment on the president. Powell said not appropriate for him to do so. Also trying to reassure the public, and he did get follow-up questions about this. They are politically independent. Public should be confident we'll continue to just do our work, focus on using our tools to achieve our goals.
Yeah, and he did talk about the modeling that the staff at the Federal Reserve is doing on fiscal policy, as they are with a broad range of other economic inputs, right? But he named four things specifically: tariffs, immigration, fiscal policy, and regulatory policy as being the sort of things that could affect the economy and therefore eventually affect monetary policy. But bottom line is, he does not seem to be in a rush, right? He wants to see that stuff work its way through the system. He wants to be patient. He demurred when asked if a rate cut in March was off the table. But interesting headline from Krishna Guha over at Evercore ISI, the vice chair there, saying in a note, Powell press conference significantly less hawkish than Fed statement, which I thought was interesting. He said at least sort of halfway through. So that's some of the early commentary.
Elon Musk came up as well. That was interesting. Elon Musk has made some news saying the Fed is overstaffed. Powell asked about that, said we run a careful budget process. She said no further comment, no further questions on that. Too.
And then finally, one other thing that stood out to me, there's been a lot of talk about whether the Fed should change its inflation target. He said, no, we're not going to change the inflation goal anytime soon.
Jen Schonberger, our very smart colleague, I liked her question to him as well, saying, listen, but you have to get back to target in order to cut. And he said, no, that's not true. I just got to think I'm on the right path, right?
Exactly. All right, let's get more Fed reaction now. We welcome again Charles Schwab's Kevin Gordon and JP Morgan Asset Management's Kelsey Barrow. Guys, Kelsey, I'll start with you. Just general reaction, anything that stood out to you from the presser?
Yeah, so there's probably three things that I took away from the press conference. One is the question we were talking about before it started, which is, does Chair Powell still believe that policy is restrictive? He said yes. It is less restrictive than it was. We're 100 basis points lower on the Fed funds rate, but yes, policy is still restrictive. Therefore, what is the next move? At each incremental meeting this year, what are they looking for? Either a hold or a cut. So what I'm seeing is it's still an easing bias that the Fed is generally maintaining. And then what will necessitate, what do we need to see to get that rate cut? Well, he put forward two things. Either one, further progress on inflation, or weakness in the labor market. So I think he gave us fairly clear thresholds in terms of what he needs to see. And then finally, the speed in which he addresses those, not in a rush. Right. So he wants to see further progress in inflation. It should result in more rate cuts this year, but it's going to be a gradual process.
What about you, Kevin?
I think that, in terms of the March decision, and he was repeatedly asked about it, maybe this is semantics and I'm reading too much into the language, but I find it interesting, though, that if he was really, if a cut was truly on the table at this point, I actually think that he probably would have opted for language around data dependency, not repeating the fact that, we're not in a hurry. To me, that says that they're really not looking at as a base case right now. Of course, that could change, but I think that from a labor market standpoint, and I kind of go back to some of the comments that Powell made last year, specifically around labor market revisions, where every jobs report they get, he's sort of mentally adjusting downwards some of the impacts from revisions over time. I do think that that's going to become a more dominant factor in policy this year, especially because of the comment he made, and I thought it was probably the most important thing regarding the labor market, which is that we're still in this low firing, low hiring environment. But the more important point I think that he made was that anything to disrupt labor at this point in terms of causing layoffs to spike, once you get that catalyst and that upward momentum, it's pretty hard to rein that back in. So I think that wanting to preserve the optionality to cut more, and his point about they're still feeling that they're pretty restrictive right now, that means that they still have a pretty wide gap from where neutral is, and they have optionality to cut a lot more if labor were to get out from under them, and sort of you started to see that upside momentum in the unemployment rate.
Let me ask you, Kevin, so if you've hit this sort of wait and see mode here, if we've kind of hit a pause button and Powell and the Fed are thinking, we want to wait for Trump policies, see what they are, what form they take, when they come. If that's the take, and you're a viewer listening to this, you're an investor, what do I do with the wait and see mode? What does it mean for me, my portfolio?
Well, it's hard because historically, and of course there's a wide range in terms of Fed cycles and what it's meant for markets, but if you look at the U.S. stock market at least, historically it's been better, all else equal, for the Fed to be in a less aggressive cutting cycle, even if that means taking a pause. But we also don't really have any precedent for this, simply because of how this cycle started, with a 50 basis point rate cut and the economy not being in a recession. That kind of excludes any historical analysis that you could use, or historical analogy from a Fed cycle standpoint. So, we just have to kind of take it as the Fed does, and from a data standpoint, and look at what growth is, which right now relatively healthy, probably reinforced by tomorrow's GDP data. The unemployment rate still stabilizing in a range now, which is incredibly unusual relative to history. Typically, it's going down or it's moving up pretty quickly. You don't really see it move in a steady range like it has. And then from an inflation standpoint, you're still, if you zoomed out a few years, we're still in this broad disinflation. Of course, we've had a little bit of a stalling of that progress, but those three key pillars of the economy are still relatively healthy. So if the Fed is pausing for that reason, probably not, an Armageddon scenario for the market, but there has to be readjustment along the way.
And what happens to rates, Kelsey? Because, it's been a weird year in rates, right? Because we were seeing, even though there was the expectation that the Fed would be cutting, and then they did cut, rates went up. And now rates have been moving down, at least on the 10-year since the inauguration. And we've sort of now taken the Fed out of the equation to some extent, at least for now.
Yeah.
So what now?
So I actually think for fixed income investors, this is a very good environment. And what we are really communicating to clients is that you don't need to see further rate cuts to get very attractive risk-adjusted returns in your fixed income portfolio. And that's because starting yields are so attractive. So if you think about a core portfolio that's yielding 5 to 6%, or a lower quality high yield portfolio, which could yield 7 to 9%, those are starting yields that are quite attractive. And you don't need the Fed to be cutting rates or rates to even move materially lower to collect that carry. So what we would call it is it's that classic carry environment. And the Fed staying on hold, if they do stay on hold for an extended period of time, also is an indication that the economy is probably still doing well. So as a fixed income investor, the companies that we're investing in, the fundamentals of those companies are likely to stay strong. Their balance sheets are likely to stay healthy. So ultimately, a range-bound Fed, range-bound yield environment allows you to collect carry, and at high starting yields is a really good starting point to make sure you have fixed income within your portfolio.
Kelsey, Kevin, it was great to have you both here today. Appreciate it.
Guys. Thanks.
Thank you. The Federal Reserve holding rates steady. Let's get to Yahoo Finance's Jen Schonberger with the details. Jen.
Josh, Fed Chair Jay Powell would not answer President Donald Trump's call to lower rates by a lot, nor has Powell had any contact yet with the president. Take a listen.
I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated his demand to you?
I've had no contact.
Powell says the Fed is content with the current policy stance, and that even though there has been progress in the last couple of readings on inflation, the Fed is not in a hurry to lower rates or change the policy stance anytime soon. Take a listen.
With our policy stance significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance.
Fed Chair Powell believes that the Fed is meaningfully above the level of neutral on the Fed funds rate. That is the level that neither spurs nor slows economic growth. And he says the Fed does not need to wait until inflation comes back to 2% before the Fed cuts rates. He noted that the removal of language from the statement that the Fed is making progress towards its 2% inflation goal is not any indication that the Fed doesn't think that they are no longer making progress towards inflation. He says that the Fed was merely just cleaning up its policy statement. Now, when it came to trade, Powell again noted that he is waiting to see what the actual policies are before the Fed actually takes action. He did note when I asked him about whether trade uncertainty could cause businesses to pull back and weigh on economic growth. He said right now he's not seeing any evidence of that, but that is certainly something that could happen in the future. That's something that we saw a little bit play out back in 2018, 2019, when we saw President Trump then levy tariffs. He was also asked about the impact of deportations on the border, and he said that that's actually acting to help the unemployment rate stabilize, and that's something that we saw Fed officials note in their policy statement. He also noted that the Fed is undergoing its 5-year policy review now, and that we are, quote, not going to change the inflation goal anytime soon. Guys?
A lot of declarative statements out of that meeting today. Jennifer Schonberger, thank you for
Indeed, there were, Julie.
Yes, thank you for eliciting some clarity from him on that 2% target. Appreciate it. Well, it was a busy day in Washington, aside even from the Fed. The Senate Commerce Committee holding its confirmation hearing for Commerce Secretary nominee Howard Lutnick. And Lutnick doubled down on President Trump's calls for tariffs.
I prefer across the board. We are treated horribly by the global trading environment. They all have higher tariffs, non-tariff trade barriers, and subsidies. They treat us poorly. We need to be treated better. We need to be treated with respect. And we can use tariffs to create reciprocity, fairness, and respect.
Ben Werschel here with the takeaways. So, Ben, that seems to be one of the big ones, what his sort of line there on tariffs.
Yeah, for sure, Julie. He was, that clip you saw there, very, very definitive, and gives you a good sense of Lutnick's view here, and which he also added is Trump's view and his view, that they sort of think very similar on this lines. But there was a lot of tariff back and forth today. This was about a 3-hour plus hearing, and there's other areas where I think he kind of added to some of the uncertainty we're seeing around tariffs as part of what Powell was talking about this afternoon. He talked about tariffs in the context of DeepSeek, the AI tool that that's been rolling market this week. He talked about how DeepSeek, in his view, has stolen things, and tariffs to him are part of the solution. He seems in favor of the export controls to kind of keep American chips out of China, but he also says tariffs need to be part of it. And if tariffs aren't there, it's sort of a whack-a-mole is how he described it. This all comes out, of course, as President Trump has promised 25% tariffs on Mexico and Canada and 10% duties on China as soon as this Saturday, so just within a couple days. And we still don't have total clarity on exactly what those are going to be. One other piece from Lutnick today that I took note of is that he indicated that he's behind these broad tariffs. Tariffs are going to be a big part of Trump going forward, but there's an outlet for Trump if he wants to back away this weekend. He talked about how if Mexico does certain things that make Trump happy, there could be, quote, no tariffs, at least in this initial phase, even though in his view, they're going to be coming down the road.
Yeah, and the Mexican President Claudia Sheinbaum being quoted today saying she doesn't think the tariffs are
exactly.
going to be
And the markets,
going
I think, are the same thing. Nobody really knows exactly what these are going to look like.
Well, Fed Chair Jay Powell did talk about a lot of uncertainty. So
wait and see, for sure.
Exactly. Ben, thank you so much.
Thanks much.
Well, that concludes our Fed Day coverage. Stick around. Market domination begins on the other side. Welcome back. It's time for Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That's Josh Lipton. And let's take a look at what is going on in the markets following the Fed's keeping rates steady. Jay Powell in the meeting, as expected, really pushing back against any idea that they would be political. They are taking into account what's going on in Washington in terms of the effect on the economy, of course. And he said we're not changing our inflation targets. We are seeing stocks come up off the lows of the session. The Dow barely negative now, not even down 1/10%, about 80 points here. The S&P 500 down about a third, it too up off the lows of the session, and the Nasdaq down about 0.4%. Ditto there. I also want to take a look at what's going on in the bond market, because what's interesting here is the lack of what's going on, right? We saw bonds kind of creep up a little bit and then come back to the unchanged level after that, after that presser, which maybe is what Jay Powell would want, right? And we were seeing some commentary ahead of time that Powell and company want sort of an uneventful decision and meeting today, and maybe that's what they got.
Maybe he stuck the landing there. I mean, listen, they telegraphed a pause, Julie. You got the pause. Some takeaways: the economy is solid. That's how the Fed is describing it. Inflation, not where they want it to be, but we know that. They're not back to target. I thought our own Jen Schonberger asked a great question to Powell when she said, listen, okay, does that mean you have to get back to 2% to start cutting? He said that's not the case. Right. We just we're confident we're moving in the right direction. I thought one of our great guests today also made a good point, asked about whether they're restrictive, and Powell saying we are restrictive. We might not be as restrictive as we used to be, but we are restrictive. Her point being that would seem to indicate the easing bias, at least, is
still intact. Exactly. Let's take a look at the groups that are on the move within the S&P 500 today. We've got real estate that it's in the red more steeply here, seen as a interest rate sensitive sector. Tech is also down. Healthcare is also down. Then you got communication services and utilities that are higher. Utilities also an interest rate sensitive sector, but one that had been falling for a couple of days in the wake of the DeepSeek introduction. And finally, it's not all about the Fed today. Maybe it's not even mostly about the Fed today. I don't know. Tomorrow certainly will be about big cap tech. And we have three big companies reporting after the bell. We're going to have Microsoft, which ahead of that print, down about 0.75%. We're going to have Meta, which is up about the same amount. And we're going to have Tesla, which is down 2%. The other stock that's getting some attention today is Nvidia, after a report from Bloomberg that the Trump administration was at least talking about maybe putting some new export controls into place. That stock down 5%.
Yeah, it's so interesting because these big tech earnings are on deck. Just a week ago, a Chinese AI company, DeepSeek, that was not on a whole lot of people's radars. Yeah. It is now, and you can bet those CEOs are going to get pressed on that in those conference calls.
We're going to be doing that word search quite a lot on those conference call transcripts. Well, it's only Wednesday, but it has already been quite a week for the tech sector between the arrival of China's DeepSeek AI model and big tech earnings on tap. Joining us now with what to expect from some of those earnings, Yahoo Finance's Dan Howley. As we said, a lot of DeepSeek talk, most probably.
Yeah, Julie, I think a lot of investors are going to be wondering what is their company that they're following doing to combat DeepSeek and the seeming, overnight success of its AI capabilities. Now, let's just go over two of the big companies first. We have Microsoft and Meta both reporting at 4:05, so that's going to be a lot of fun for me to write up. What Microsoft is expecting in the quarter, analysts are expecting $3.13 on revenue of $68.8 billion, 68.9 we have there. And then that would be up from the $293 the company reported last year in the same quarter, and $62 billion in revenue. So as far as Microsoft's cloud segment goes, that's the important indicator here, the commercial cloud, and the expectation is 41.1 billion in revenue, up from 31.9 billion. And then the intelligent cloud business, that includes Azure, is expected to come in at 25.8 billion, up from 21.5 billion. And I think the big question here are, will we see an increase in consumption as far as Azure usage? What does that mean as far as OpenAI and their Project Stargate that they have going on with SoftBank and Oracle? And then whether or not, and this is kind of a backstory, but they're going to see any kind of growth as far as PC sales go. They're making that big AI PC push. I don't know if anyone's really buying a PC because of the AI PC aspect of it. I think is it faster? Does the battery last longer? Does the screen look good? kind of the same
Those
thing
are
with
good
phones.
reasons. Those are good reasons.
So the other company that we want to take a look at is going to be obviously Meta, and they're going to report again, as I said at the same time, revenue for Meta is expected to come in at $46.9 billion with adjusted EPS of $7.67. The amount that they came in last quarter with advertising revenue was $38.7 billion. Sorry, that's what they're expected to come in with for this quarter. The last quarter they had announced was $45.6 billion. The big deal here with Meta is obviously what Llama is going to be doing. They've made this open source model. They've been championing the open source AI kind of push, and now they have DeepSeek come out, open source as well, out of China, and seemingly blowing Meta out of the water when it comes to their capabilities. Now, some analysts have questioned the veracity of DeepSeek's claims, saying that we don't know exactly how much it cost. Really, that $5 million they say that they used to train it.
Dan, we had some. I mean, we did have some smart, longtime analysts on the show, and who were bringing that up. I mean, the question of DeepSeek's claims and whether they're overhyped. Some of them were kind of skeptical, or at the very least on that issue of how much money they say they're spending versus their American rivals. But you've been thinking about it, writing about it. What do you think?
Well, just quickly, too, and OpenAI says part of the way maybe it got around all that was just by scraping its models.
Right, and we can, discuss the, hypocrisy of OpenAI and scraping.
Its own scraping.
Yeah, so.
A lot of scraping.
Yeah,
everybody's scraping.
Yeah, what is it? Great artists steal.
Yeah.
But I mean, this is something that I think that they're going to have to continue to answer to, especially Meta, when it comes to this, specifically because they're building open source models, and DeepSeek is clearly going to compete with them.
Yeah, they are. Dan, thanks a lot. Well, Chinese startup DeepSeek sending stocks on a roller coaster this week as it rattles the AI ecosystem as markets assess DeepSeek's challenge to the assumptions about AI spending and costs. We're taking a look at how this trickles down into options trading. Scott Bauer, Prosper Trading Academy CEO, joined us now to discuss in the options bit sponsored by Tasty Trade. Hey, Scott, it's great to see you.
Julie, how are you? Thanks for having me.
I'm doing well. I'm curious what tech positioning was looking like coming into this week, even before the DeepSeek blow up, right? What were you seeing in the options market in terms of how people were setting up for earnings?
A lot of out-of-the-money call buying, to be quite honest with you. Far, far greater than on the downside. The option skew was absolutely to the upside.
And what does that mean? That means optimism.
So it means optimism. So let's say, for instance, right now, Nvidia is trading 122 right now, basically. So if we were to look at equivalent strikes above and below 122, so let's just go $10. So the 132 call, 112 put. Going into this week, the call side was trading more expensively than the put side was. So the skew was to the upside, and like you just said, a lot of optimism.
Scott, let's get some trades for viewers. One is Corvo, QRVO. I know you got a trade on that. Walk us through it.
Absolutely. And, earnings were not that well received after a nice little run up in Corvo. And that's because they warned of potentially flat sales to its largest customer. Their largest customer is Apple. Apple accounts for about 50% of their entire revenue. But this is why I'm bullish, because in this whole, shakeout of what we've seen over the last couple of days or so, Apple has really been the shining star here. So I think there's a lot of optimism and a lot of upside still to Apple, which then to me is going to flow down to Corvo. So in Corvo, I'm going out to the March expiration and I'm buying the 90-95 call spread. I can do that for around $1.20, $1.25 or so. And if you look technically at the Corvo chart, there is a really nice big gap to fill up at around $100 from a few earnings ago. And I think that's where it's headed. Any sort of decent guidance by Apple should really send Corvo running.
And another trade that you're looking at, again, isn't sort of one of the big cap techs that we've been talking about, but sort of a tertiary play, and that's Seagate Technology, which is a data storage company. Yep. Tends to be sort of more like Corvo, maybe you could argue a little more commoditized what they sell. So what are you looking at with that one?
Absolutely. And I like looking at some of these other stocks that are maybe subsets of the big guys here. So right after earnings, and they had a really good earnings report, the stock traded down to really major support right around the 200-day moving average. And this company, to me, really stands out as a major beneficiary of this storage market. I mean, this is they're one of the go-tos. So their revenue was in line with estimates on earnings, and their earnings per share, they missed by a little bit, but their guidance was pretty decent. So what I'm looking for in Seagate STX is I'm buying the February 21st. So I'm only giving this one 3 weeks. 103, 108 call spread. It's $5 wide. Do that for $1.25. The reward to risk on that, and that's how I price out my trades, is really based on reward to risk, I think is tremendous.
Scott, I want to circle back around quickly. Looking at these two and looking at maybe benefiting from some of the lesser known names, going back to the large names that we're about to hear from and talking about that optimistic skew, right, that set up into them. What is the risk then if they do miss or if they say something disappointing for the market? Is there a bigger risk than there normally would be, I guess is what I'm asking.
It all depends how someone, positioned themselves. If they just flat out bought calls because they were optimistic, well, if it's disappointing and the stocks go down, they can't lose more than what they paid for whatever the option was, whether it was $1, $1.50, $2, whatever it was. But what it's telling me is if there is disappointment in any of these stocks here, some of the people that are maybe caught on the long side here are going to be scrambling a little bit because, again, with that skew to the upside, there may be surprises coming in here. But, you have today, you have Tesla, Microsoft, and Meta. So unless all three really, come out with the same sort of report, the same sort of guidance, whether that is all on the optimistic side or the pessimistic side, you could see a Nasdaq market based off of this that could be relatively unchanged.
Scott, thanks for your time and those trades. Appreciate it.
Thank you, Josh.
Stick around. Much more market domination still to come.
Nvidia investors facing a tough week so far as the threat of China's DeepSeek wreaks havoc on the stock, and now also a report about further export controls to China. Our next guest believes that the declines could be a bad sign for the rest of big tech. He made the case in a New York Times op-ed. Joining us now, Mihir Desai, a professor of both finance and law at Harvard. Thank you for being here. Appreciate it.
My pleasure.
Mihir, this was an interesting op-ed because you sort of talked about the, and I'm not going to try to say the word.
Ouroboros.
Ouroboros,
there
thank you. I didn't know where the accent was. But the serpent that eats its own tail.
Yeah.
So explain to people why you're thinking about big tech in that way.
Yeah, so this is really colorful metaphor that's been around forever of a snake eating its own tail. Right. And I used it just to try to understand the most interesting puzzle of the day, which is how can 7 companies constitute more than a third of the market capitalization? That's just something we've never really seen before. And there are different explanations for that. One explanation is the AI boom is going to accrue to them and exclusively to them. So there's going to be all these gains and it's all going to go to the 7. That can make sense. Alternatively, soon the unmagnificent 493 will catch up because all those productivity gains will go to them and then everybody will kind of catch up to where the big magnificent 7 are. I wanted just to raise one other possibility, which is I think what's really going on here is that that magnificent 7 is being viewed as a safe asset. So for investors around the world, they think to themselves, in a world of uncertainty, who do I trust? And the answer is big tech, fortress balance sheets, cash flows out the wazoo, fantastic management teams, why not? The problem with that, of course, is once you view them as a safe asset, then your expected returns go down. And managers there have been doing what you would expect them to do, which is with a really low cost of capital, they've been spending money like crazy and literally on each other and on themselves. And that is a serpent eating its own tail, which is just a way of saying they've been spending money on each other. What does that mean? You know, Nvidia's top 4, more than 50% at least is from the top 7. They spend money on each other in all kinds of ways. They have been doing an infrastructure spend that is remarkable, like we've never seen before. And then, of course, they've been doing buybacks, hand over fist. And that is literally a serpent eating its own tail. And what's that going to result in? Ultimately, what you should expect it to result in, which is pretty low returns. And that is how this kind of unwinds in a way.
What if AI is more is kind of fulfills the promises of its greatest fans and optimists? Then what?
Yeah, no, I think if let's go down that path. It's a general purpose technology then, and then it lifts up everybody, and there is a massive productivity boom that just keeps on going and keeps on going and keeps on going. I don't think there's a couple of problems with that. First, we haven't seen a lot of evidence of it. We haven't seen.
But it's such early days here too. I mean, you could even look at DeepSeek AI today. I mean, there was a company a week ago, Mihir. How many people have heard of DeepSeek and they go in, they throw this grenade, and it goes on, and that'll probably be a focus of all these conference calls.
I think in a way they're misreading the lesson of DeepSeek. The lesson of DeepSeek is there are no competitive barriers here. There's no competitive barriers.
If you believe all the claims of DeepSeek.
Well, if you don't believe them, then it's not that revolutionary. If you do believe them, then the lesson is, wait a second, who's going to get the barriers to actually get up all these rents? In fact, it's just going to diffuse. And so I don't think in that story we would think that all these stocks are going to do well. And the reality is we haven't seen the killer product. And the reality is, you know, tech has been promising to change the world for 20 years, and it's kind of been low productivity. And so I don't think we should think things are going to change. That doesn't mean technology is not amazing. It's just that this is like a continuation. It's just not a step change. People are heralding it as a step change. And my instincts are it's not a step change.
You don't think it's like, because some people say internet, mobile, AI, it's a paradigm shift.
It could be. But again, it takes time. I mean, it takes a long, long time. And I think what we've seen is just a kind of a collapsing of that horizon where people think it's tomorrow. And it just isn't going to be tomorrow. I'm not saying it's not transformational. I'm just saying there's going to be a lot of capital has already been deployed in this direction. And yet we don't really see revenues associated with it.
Well, I guess that's the question. Even if you argued it was a step change, even if it was this huge revolution, and it is going to happen in 2 years, is the profit growth going to match that? And is it only going to accrue, or even majority going to accrue to these companies? Are they going to get that, is Meta going to get its return on its $60 to $65 billion investment this year?
Yeah, and it's even more. I mean, Microsoft is now
$80
billion. And these are massive amounts. So you have to generate remarkable amounts of revenue in perpetuity to justify that. And the reality is they're just eating their own tail. They're spending money on themselves and on each other, and it's just a cycle. And that is something that can yield really low returns over a long time. So the way this resolves itself is not some kind of a pop in the bubble, but just like it did with the railroads and steel.
Oh, is that the comparison you made? I was going to ask you, are there periods in financial history here you would look to and say, okay, these are kind of parallels?
Yeah, so it's fun to look back in history. And so I have a piece, part of that article has like a little detour into railroads. And of course, what happened after the 1890s and 1880s, which were these really remarkable periods of growth, was like a decade plus or 2 decades of really low returns. And that's, I think, where we're going. It's a little bit more like that. It's not like a pop in the bubble. It's not like the unmagnificent 493 becoming magnificent. It's more just a grind. And that, I know, is what no one wants to hear, Josh. Like, I know no one wants to hear that.
It doesn't sound exciting to hear.
It does. Well, it's not my job to be exciting, fortunately. But I think it's right. And I think that's what all these low return investments yield, basically. And it'll take us time to figure that out, because we could turn out to be wrong. I could turn out to be wrong. And tomorrow we could be like back and AI could be generating massive returns.
And well, how do you write back, Mihir? That's the beauty of it.
Well, I'd be delighted. I'd be delighted.
Well, and one thing's for sure, on those conference calls, people are going to be getting questions about all that money that they are spending.
Indeed, as they should be, as they should be.
Mihir, thank you so much for coming in. Really appreciate it.
My pleasure.
Well, while we're wrapping up today's market domination, don't go anywhere. Of course, after the bell, the earnings fun begins. We'll get the latest numbers and analyst reaction from Microsoft, Meta, and Tesla. Oh, we're going to sneak IBM in there, too. Stay tuned for Market Domination Overtime. That's closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. Let's look at where the major averages ended up after we got a hold steady on rates from the Federal Reserve and a press conference from Jay Powell where he said that the Fed was going to be really watching the inputs from Washington and their effect on the economy. Seem to indicate that the Fed is on pause for now unless something changes in the economic data. If you take a look here, we see stocks closing off the lows of the session here. here, but also, not at the highs. They still negative for the Dow, off 137 points, about 0.25%. The S&P 500 down by nearly 0.5%, and the Nasdaq down about the same amount as well. We've been watching, of course, bond yields today, and they haven't moved much. There was a little bit of a movement, right, while Powell was speaking, but when all said and done, holding steady at around 4.56%. Of course, we are looking ahead to large cap tech earnings after the bell. Microsoft finishing lower 1%, Meta up 1/3, and Tesla down 2.25%. Nvidia up off the lows of the session, but still down 4% on the day on a Bloomberg report that the Trump administration is discussing some new export controls on chips that it has been shipping to China. We'll see how that shakes out. Josh?
All right, Julie, an up and down day on Wall Street as the Fed paused its rate-cutting path. But now the real fun begins with an onslaught of tech earnings. And Steve Sosnick, Interactive Brokers Chief Strategist, is here to help us break it all down. Steve, great to see you, as always.
Great to see you, Josh.
Let's start with the Fed. They signaled a pause. They telegraphed it. You got the pause. Some subtle changes in the policy statement, but walk us through your reaction to the Fed statement and decision and what it means for investors, Steve.
My first thought on the whole thing was, removing the language about inflation, plus, basically saying that labor was in a good situation equals don't hold your breath for interest rates so quickly. Concern all along is that we get too focused on rate cuts at the expense of the economy. If labor's okay, that's not a bad sign. But remember, a couple weeks ago, after the last jobs report, we sold off hard despite the labor market being good. And so the investors have to figure out now: do you want rate cuts, or do you want a strong economy? You're probably not going to get both. It's pretty hard to do both. And Powell pretty much said you're not getting both.
Well, the market seems to have come to peace with the idea that it's not getting cuts. The problem is, I guess, if there would be another change in the outlook. Is that fair to say?
I do think that's fair. We're still sort of more or less around the 2 rate cuts that are in the dot plot. There was no dot plot. There was no summary of economic projections.
We have to wait till
Got to wait 6 more weeks for that. So this was never going to be as consequential of a meeting. I think the questions that everybody was curious about was, how does fiscal policy wrap into this? And I think, Chairman Powell basically went out of his way to sidestep those questions, whether it was about presidential interference or how fiscal policies might transpire. Quite frankly, they may be just as confused as the rest of us.
Yeah.
Steve, we've got earnings. Let's get into it. Microsoft just crossing the wires here. Microsoft Q2 EPS at $3.23. I don't see a comp yet there, Julie. 323 is what I'm seeing on the bottom line. Q2 revenue, though, $69.63 billion. That's a beat. The street was at $68.92 billion. Azure revenue, this is interesting. That clocks in at 31%. The street was closer, it looks like, to 31.8%. It also looks like Microsoft here is saying AI surpasses that revenue run rate of $13 billion, up 175% year over year. Remember, we don't get guidance from Microsoft here. You would expect that on the call, which comes later. It's when CFO Amy Hood will walk you through the forecast. Initially, we're seeing a drop here, about 4% in the after hours, Julie.
Yeah, and it looks like that is on the cloud miss, specifically that Azure revenue rising 31%, a little bit short of estimates here, even though they came out with that AI number. Intelligent cloud, that's where that AI number sort of lives, coming in at $25.54 billion, $25.89 billion is what analysts had been anticipating here. So a lot of questions about this, right? And of course, we are expecting questions on the call about the vast amount that Microsoft is spending to build out its AI capabilities, to build out its data center infrastructure. We've heard from the company that amount this year should be around $80 billion. And so that's something that the DeepSeek model, as we've been talking about, perhaps brings into question, and they will undoubtedly be getting some questions about that on the call.
Oh, clearly. I expect everybody today, you've got particularly Microsoft, Meta, Tesla, but there'll be others. Maybe they won't do it on Levi Strauss or something like that. But, asking about how DeepSeek will affect things, because what I think Monday told us, at least in my mind, was it doesn't negate the premise of AI. As a matter of fact, I think it actually makes it more egalitarian and easier and cheaper, and potentially brings forward a lot of the benefits On the other hand, if you're Microsoft, who has this huge investment in OpenAI, and who is pretty much therefore wedded to that OpenAI model of big investment in chips, big investment in hardware, big investment in the data centers where to put those things, and big investments in the energy that requires the power. Well, that's where the DeepSeek might have thrown things off a little bit, and this is what we need to hear. And I'm sure we're going to hear it about anybody even remotely related to AI.
Yeah. On Azure, I'm going to be really curious to hear what the puts and takes they're seeing in that business. Again, 31%. That does just miss what the street was looking for at 31.8. So when CFO Amy Hood is on there, starts giving you forecasts, investors are going to clue in on that. What does she see ahead? What does growth look like there in the second half of 2025? What are her expectations?
We got Tesla numbers as well, so we're going to move to those Tesla fourth quarter earnings crossing the wire. And that company missing in terms of its earnings per share of 73 cents versus the 75 cents that analysts had been anticipating. Fourth quarter revenue at $25.7 billion. That is a little bit above estimates. Fourth quarter gross margin overall at 16.3%. The average analyst estimate at 18.9%. So those are some of the headlines here. The company also says that its 2025 energy storage deployment should grow at least 50% year over year. That has been a bright spot in the business, as the car business has not done as well as some were anticipating. The company says it expects that the Cybertruck will be eligible for an IRA consumer tax credit. Not sure how that works, but we'll get to that. And the company also highlighting that it achieved record deliveries in China in the fourth quarter. It says it anticipates Cybercab scheduled volume production starting in 2026, and that the vehicle business overall should return to growth in 2025. A lot to sift through in that statement there. Also, just to put things in context here, as we see the stock pulling back in reaction to the numbers, the stock is up more than 50% since the election, as the first buddy has been everywhere in Washington, and there has been this assumption on the part of some investors that there would be some benefits accruing to Tesla, even as we have seen the White House pull back from things like electric vehicle incentives. So we'll see what this call looks like, guys.
Yeah, it was interesting because you saw, of course, and we talked about this Trump-fueled surge, Julie, from there. To start the year, it wasn't as great, and now we're pulling back a little here in the after hours. It'll be interesting. I want to hear more about the margin miss. I think is again, Q4 course margin 16.3. It's really closer to 19 on there. I think front and center will be that low-priced EV. There's been talk about that. Do we still think that's coming in the first half? Do we still think that's around 30,000? What could that mean for growth? The federal EV tax credit, that'll be front and center. If that gets cut or if it just goes away entirely, what does that mean for Tesla? And then we know, of course, there's all been that hot talk. This is going to come up the core. The Trump team may be easing self-driving rules. We've had bulls on the show who've made a lot of that, of course, as well, Julie.
Well, I mean, as far as I'm concerned, you know, Julie, you hit it on the head. The stock's up 50% since the election, 80% since its last earnings call. That's since before its last earnings call, when it went up, I think, about 20% after that. So this stock has had a huge tailwind behind it, although lately it's actually been moving in the opposite direction. Yesterday was the first day in 5. I think it was after 5 declines. It was up very slightly. Today we were down coming into the number. Now we're down into it. You put a lot of air under it, and it's tough to maintain that kind of enthusiasm. You know, you made the comment about, you know, how's the Cybertruck going to be eligible? That's where the proximity to the president comes in, and we'll see if that transpires.
I guess we will.
Let's get another perspective on this. For more reaction to Tesla earnings, joining us now is Craig Irwin. He is senior research analyst at Roth MKM. Craig, it is great to see you. So Tesla reports the initial reaction here, at least immediately. Craig seems to be disappointment in the after hours, but what do you make of the report?
Yeah, so you guys hit the nail on the head. This is all about adjusted gross margins, and we do not have the FSD revenue released in the quarter yet. But if you adjust for credits, it looks something like 13.6. So they had been talking down margins in the quarter. The quote-unquote buy-side consensus was 15, so this would be a miss versus that. But recall last quarter we said that, hey, you know, there was a big drop in in battery prices during the September quarter that boosted the margins by a couple hundred basis points. The CFO was very clear on the last call. It was not going to repeat. So this is more or less as we expected. And we did say when we upgraded the stock that this should be the last quarter of a negative delta like this. They're looking at share gains. They're looking at, significant progress in their most exciting businesses. And they got a nice refresh on the Y right here. So, we would actually look at this as a buying opportunity.
Craig, maybe the less exciting parts of the business, I want to linger there for a moment, because on that subject of regulatory credit, in the third quarter, they made $739 million from selling regulatory credits to other car manufacturers who were trying to comply with pollution regulations. Does that business still exist under, I don't mean like today, but I mean going forward under the Trump administration?
I mean, it's going to be around. A lot of that is actually state-driven. So California credits are a very large chunk of the regulatory credits. It's not exclusively U.S. It's global in nature. So, growth driven by federal mandates in Washington, no, I don't see that. But this is a very important line item that I think is here to stay for a while, at least a number of years. I don't see that as something that is particularly at risk right here, right now.
So, hi. My question would be how much of the revaluation that we've seen in just the last 3 months is really related to their underlying business vis-a-vis Musk's proximity to the president, and because it's very hard for at least for me to separate the political from the from the operational. And so it doesn't seem as though the operational got 80% better since last earnings time. So how much of it? Exactly. How much does you attribute it?
So what's going on here is there is intense enthusiasm for the cyber taxi, robotaxi business, and similar enthusiasm for both Optimus and AI. So the cyber taxi, robotaxi business, the rollout wasn't really that exciting. But the fact that we're going to see an accommodative environment for that business over the next couple of years, with Trump and Musk being bros, right? I mean, you can imagine fairly achievable regulatory hurdles to get those trials out and to get these vehicles vetted and to develop a business here because of the potential transformational nature for the economy. And safety, with the success here. Optimus, I think, is a little bit further out, but it's nice to dream about humanoid robots. AI, the big spook in the market. So yeah, I mean, listen, it's a bit of a dream right here, but there are a lot of investors that love that dream. The one that clearly is not as big a piece of the valuation that it is for others. You saw the move in Nvidia the other day versus the move in Tesla. Proportionately, people are saying that the use of AI for autonomous is not really at risk the way AI is in other areas of the economy. So, there's some very exciting pieces of the business, and investors are willing to be, more aggressive in the way they discount these for the future growth.
Craig, you were waiting for that automotive gross margin ex regulatory credits. It looks like we got that headline at 13.6%.
Yes.
That
was the number I said. So FSD revenue released is the one that actually matters. That's the next piece. That's the piece that's missing. I did say 13.6. The last quarter was 15.6. The year ago was 16.8. So that is clearly a miss. And our last quarter note, and everything we've said in our public appearances, we have expected gross margins to miss. We understand management's been talking down gross margins during the quarter. This is probably got some one-time items in there because that was a little worse than what I was looking for. But I fully expect that this is the last quarter where we see these negative deltas, given that we're going to have positive deltas now, both on the ability to pass through price, on the refresh of the Y, and on a much wider pool of buyers, with conservatives obviously having some enthusiasm for Elon Musk.
Craig, let me also ask the other headlines dropping here that more affordable models are on track for output starting in the first half. So that lower priced EV, Craig, would you still assume around roughly $30,000? And what could that model mean for growth?
Oh man, I've been talking about the mini car since 2019, and they punted in 2019, and it was the biggest strategic bungle at the company, that I've seen. Right, it was a big mistake. Now that they're going to go forward with this car, it's not going to be with a transformational approach, modular manufacturing. It's going to be a get it out the door, get a great car in people's hands, and working it from there. And that's a good thing. It's going to be supplementary for growth. That's probably going to be one of the things that gives them a little bit more visibility for, 20% plus deliveries growth this year. There's a lot of skepticism around the deliveries growth, given the withdrawal of retail credits for EVs. But this is one of the things that's going to give them growth, and it's going to give them exciting new markets, particularly in Europe and other areas where the drive cycle, people don't drive as long, and they tend to buy less expensive cars. So very exciting car, and it's going to be nice to see that on the road in the first half.
One other headline that sort of caught our attention was about the Cybertruck, saying that it is eligible for the IRA consumer tax credit. Can you explain that one to me, Craig? Or I don't know. Or what does that mean? Because isn't it too expensive to qualify for that? And isn't that credit going away anyway?
We have to see. There's a lot of uncertainty in D.C. right now. I think Musk has more clarity than you or I. So we got to trust him in this in the release. I was I was working with the understanding that yes, the vehicle is too expensive. Clearly they know something we don't.
Well, we'll find out, I guess, Craig. Yeah. Thanks a lot. I appreciate your time very much.
Thank you.
Coming up, we're going to get analyst reaction to other earnings that are just coming out. Stick around, much more market domination overtime still to come. IBM out with its latest earnings report, and the stock is jumping here. It looks like it's the company's outlook that is to thank for that. Fiscal full-year revenue, I should say, at constant currency should rise at least 5%. The analyst estimate was for growth of 4.8%. In terms of the fourth quarter, revenue at $17.55 billion. That's just about in line with estimates. Operating earnings per share at $3.92, $3.74 is what analysts had been anticipating. And Arvind Krishna, the CEO of the company, emphasizing AI, of course, in the statement, saying the generative AI book of business is $5 billion inception to date, up nearly $2 billion quarter over quarter, Josh.
Yeah, it's always interesting to talk to listen to IBM on the call, how executives also just talk more broadly about the macro and the general, IT spending environment and backdrop. Bulls on this one, and I think about Evercore's Amit Dairanani, for example. I saw Amit, who's been a financial analyst for a long time, tech analyst. He was betting that 2025 was going to be just this kind of inflection point for IBM because of what he's expecting to see in their software business, mainframe tailwinds, and yes, AI. I mean, there's folks who think Big Blue is a way to play that mega AI trend.
Just a quick note on where we are trading right now. If the stock opens here tomorrow, it will be a new record for IBM. It last closed at a record around 238 or so in early December. Steve, I know you look at the sort of place of IBM in the market.
It's fascinating that we're talking about IBM doing so well as we're talking about, after a week where Nvidia and some others did poorly. IBM was the tech stock. Literally, like if you were testing a Quotron in the old days, that was always what you typed in because that was the stock. Mm-hmm. And I don't go back to the Nifty 50 days. Those do predate my professional career. But there was, the Nifty 50 or the one decision stocks, and IBM was the tech stock. It was the one you had to own. They were going to rule the roost forever. Well, and then Bill Gates came along and stuff happened, and that's probably a little bit informative to what we saw this week. Just in terms of DeepSeek. So I don't want to put all my eggs in that basket, but IBM should serve as a reminder that no matter how much of a competitive moat some of these companies may have dug around themselves, they're never 100% impervious.
Well, and yet, IBM was what we call dead money for a long time, but now it's rising to a new record. So even the one-time giants that then see a lot of competition can have, I guess, other lives, if you will, even if they're not the biggest.
Without pointing fingers, there was probably, there was certainly some mismanagement. Well, I shouldn't say certainly. There was probably some mismanagement. I have friends who worked at IBM, and they think that was what they claimed before they retired. But the current management has refocused the company. They never stopped being smart. They never stopped making really good products. They just maybe didn't pivot the fastest to the products when they needed to. And that's, I guess, another one of these life lessons about some of these bigger companies is sometimes you become a victim of your own success, and people want to if you're successful enough, people want to replicate that success. Mm-hmm. It invites competition. That's our economy.
Yeah, Big Blue. I mean, a great point you make there, Steve. I mean, it's a wonderful example of how much leadership matters, I think, too. Exactly. Joining us now with more reaction to Microsoft earnings is Angelo Zeno, CFRA Research Senior Equity Analyst. Angelo, great to see you. So Microsoft's out. We're down in the after hours, but we're actually well off the lows, Angelo. We're down about 0.5% here. We do not have guidance yet that comes in the call, but give us your reaction to that report, Angelo.
Yeah, I was actually kind of surprised when I saw the numbers and the stock was down, I think, north of 5% or around 5%. When you kind of look at the numbers here, for the most part, kind of beat our expectations. I think earnings of about $3.23. We were looking for, something closer to $3.12. Implies also a growth rate of 12%. I think on the top line, we were looking for 11% year-over-year growth, so also better than expected. What everybody typically looks out for when it comes for Microsoft is kind of that Azure growth number out there. They grew 31%. And that was in line with our expectations and largely, I think, in line with where the street was looking at. It is a deceleration from what we've seen in the prior 3 quarters, but that was expected, just partly given the delayed launch of Blackwell and the fact that they needed to ramp some more AI capacity out there. So the hope here is that we kind of see some sort of re-acceleration going into the March quarter. Again, we'll see what kind of guidance that they provide when the call starts later on. But overall, I think as far as kind of the numbers are concerned, I think it looks fairly good. I think the other kind of number that was thrown out there was Microsoft did finally give a number in terms of their AI kind of annual run rate, and that was 13 billion or north of 13 billion, I think Satya said. So I think the street was hoping for something north of 10 billion, or kind of what the company was kind of alluding to exiting the December quarter. So the run rate there actually looks pretty good.
Yeah, and it's interesting on the AI too. I see a headline that AI services were up 157%. I don't know exactly what that includes. The other interesting thing is the company says it expects Capex to boost in the coming years. And they're talking about $80 billion this year. I don't know if we're talking about Capex would help give them a boost, or they would boost Capex. I'm not sure. It's worded a little bit not clearly, but in any case, Angelo, like how important is AI to them at this point, and how soon do they need to sort of satisfy investor curiosity about how much that's contributing?
Yeah, I mean, AI is kind of the entire story at this point in time for Microsoft, right? And all eyes are going to kind of be hinging on what Satya has to say, clearly on kind of the Capex direction. And the Capex number was a little bit above what we were expecting here in the December quarter, not by much, but just slightly above our expectation. But it kind of alluded to a slightly lower free cash flow than we expected. But when you kind of think about, what the story is for Microsoft here, it's clearly going to be all about AI. I mean, clearly we got the DeepSeek kind of mess here earlier this week, and who's that going to benefit or not benefit? And we are kind of in the camp out there that, listen, I mean, you're going to have these kind of cheaper large language models out there. Microsoft is going to adopt them on a platform that should help kind of accelerate kind of AI adoption out there. But in the same respect, what does it do in terms of how much can they charge for these models? Obviously, they also have a big stake in OpenAI out there, and if the valuation of OpenAI gets revalued, that does have an impact on Microsoft as well. So there are clearly a number of factors out there in play. But if you are a long-term investor out there, make no mistake, this kind of AI adoption phase is going to continue to happen. And Microsoft, will continue to aggressively spend. And we do want to hear what they have to say in terms of the pace of spending, and I think you'll get some of that here on the call.
Hi, my question here would be regarding the OpenAI. I mean, at some point, how do they value it? Do they revalue it? Do you expect any questions about whether they will do so in light of the DeepSeek news? Is that premature right now to start thinking about that? And I guess the second part of the question is, Microsoft, it's certainly been one of the winners in AI, but yet the stock had been largely dead money for a couple months. What gets us out of that funk?
Yeah, so great questions. As far as kind of OpenAI is concerned, I mean, we probably think the valuation has peaked, at least here in the intermediate term. I think there are a number of headwinds that you do have to consider out there since kind of the emergence of DeepSeek and other kind of China-based LLMs that are going to pop up here. So from a valuation perspective, listen, OpenAI, if it was a publicly traded company, would have gotten absolutely annihilated on Monday, and that does have to get taken into account as far as where Microsoft is concerned. But Microsoft is a lot more than just OpenAI, and to be honest with you, if there was no OpenAI out there, Microsoft at the end of the day, long term would probably be okay. As far as kind of the other question out there and kind of the relative underperformance in Microsoft here over the last couple of quarters, we do kind of attribute that a lot to two reasons. One is the fact that they have been spending a lot more than the consensus out there was anticipating. And as a result, the consensus has had to continue to increase kind of the cost numbers out there or the Capex numbers out there. And that's had a negative impact on the free cash flow numbers and, of course, the valuation of Microsoft. And you've actually kind of seen multiples compress here for Microsoft on a net basis over the last kind of 6 to 9 months. The other factor out there is kind of the relative underperformance on within kind of Azure on the cloud side of things. Again, we did point to the fact that that business has decelerated here over the last couple of quarters. Historically, when that business does accelerate, and if we do see an acceleration here in the first half of this year, and the company kind of alludes to that, hopefully that is something that can act as a catalyst for the company. But ultimately, we do expect Azure, we think it's in a healthy place. But to get out of this funk, if we can kind of see some reacceleration of that business, that would, of course, be a positive sign for the stock.
Right now, the share's down about 1.5%. Angela, thank you so much. Appreciate it.
All right, thanks, Femi.
Stick around. We're continuing our earnings coverage on the other side. Breaking news, the Wall Street Journal reporting that President Trump has signed a $25 million settlement with Meta. That's over the company's suspension of Trump's accounts. Back in 2021, we reached out to Meta. The company has no comments. This had to do with Trump being suspended from his Facebook and Meta-related accounts following the January 6th attacks on the Capitol, on the allegations or ideas that he was not being truthful, that he was fomenting dissent, etc. Trump brought that lawsuit. He brought it against other social media companies as well. The one against Twitter, for example, which was run by Jack Dorsey at the time, was dismissed. This one, though, was dragged out and now is resulting in this $25 million settlement in favor of the president. We should mention, as this news is coming out in the Journal, we are still waiting for Meta earnings. Normally, they come out much closer to the top of the 4 p.m. hour. They have not come out as of yet. So putting that, for what it's worth, we're watching for those numbers as well. The share's not much changed here. But, Steve, so interesting here, obviously, to see this, the interplay between Trump and the tech industry, and then to see a headline like this.
Yeah, I don't want to get too deep in the politics of it.
We can't assume.
We can't assume. There's some odd language in some of the headlines I'm reading too, like Trump signs agreement for Meta. So is that a settlement or not? I'll assume that Meta agreed to settle it for $25 million.
That's what it sounds like.
And so therefore, at this point, it's clear that big tech does not want to antagonize the president. And perhaps one of the ways to avoid antagonizing the president, particularly with some FTC stuff coming down the pipe that has the potential to be much more consequential for Meta, perhaps it was probably the path of least resistance to just sort of say, let's find a number, what number makes you happy, what number makes this go away, and it's not a big bottom line mover for Meta in terms of the finances.
Right. Yeah. Well, again, we're still waiting for the numbers. So we'll bring them to you when we do have them.
When we do. Well, let's check in on another move to Tesla. Shares higher following their latest earnings report. This one was interesting, Julie.
The shares were lower.
Right. The headlines drop. You see Q4 earnings, they miss. And so we have a reaction to that. They report adjusted earnings of 73. Street was closer to 75. Company did, though, also say, importantly, we're talking to analysts about this, they do remain on track to produce that more affordable EV in the first half. We were asking questions about analysts whether that would still be around 30,000, but certainly some bulls have been very enthusiastic about that relatively lower priced EV and what that could potentially mean for growth.
Tesla's all about the future, Josh.
Well, that's what I was going to say. Does the trading, the bump that we're seeing in the shares, does it have anything to do with what they said today?
Two things. Never underestimate the power of active traders to buy dips. We learned that yesterday. We learned that Monday and Tuesday. And so Tesla has always been a stock that has attracted, people willing to buy dips. And in the case here, the rationale for doing so is not just strictly that the price was lower, but the sort of the future. Remember, Tesla is selling futurism. They always have been. And so as long as
and that's what Musk always reminds is folks, right? If you own Tesla, it's because you believe in this future that I've laid out.
And so they laid out the things the futurism that is required to keep the stock moving, or frankly to justify the valuation.
And Steve, by the way, that's been a big. We've had bulls on the show, and you ask them why they remain so bullish. That's a big part of it, right? That's at least their thesis as well. Trump's going to come in. He's going to ease regulations that would benefit the very future that Musk talks about. If
you value this as a car company, it doesn't make any sense. If you value it as a company that will change the future, well, the sky's the limit. And so that's always been the push-pull in Tesla.
Yeah. Sky's the limit. We'll leave it there. Yeah. All right, time now for What to Watch. Thursday, January 30th, starting off on the earnings front. We're getting some more reporting throughout the day from Visa and MasterCard. And after watching 3 Magnificent 7 names report today, we'll see another tomorrow with Apple. Apple's announced results for the first quarter after the close. That stock getting hit with 2 downgrades last week as Apple loses ground against rivals like Huawei and Xiaomi in China. Concerns mounting for what investors that iPhone sales aren't getting the kind of boost from its Apple Intelligence platform as initially hoped for.
And also we'll get some economic data, GDP figures for the fourth quarter coming out in the morning. Economists forecast GDP will slow to 2.7% compared to last quarter. They're also expecting the surging goods trade deficit we saw earlier today to cut into fourth quarter GDP.
And moving over to housing, monthly pending home sales data is coming out in the morning. Sales expected to show on a month-over-month and year-over-year basis as higher mortgage rates and elevated home prices continue to weigh on the housing market.
Stick around, we're asking for a trend on the other side. It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Meta reporting fourth quarter earnings. Let's get you those numbers. Meta's fourth quarter EPS 802. That is an easy beat. The street was at 678. Revenue 48.39 billion versus the street's expectations of 46.98 billion. So that's beats there on the bottom and the top. Turning to the guidance, Q1 revenue they're calling, Julie, for between 39.5 billion to 41.8 billion. Street was closer to 41.67 billion, at least initially here. You see the shares are a bit all over the place. We're down about 1% here.
The company says it's not providing a full year 2025 revenue outlook, but we are getting an outlook on expenses. Total expenses this year going to be, ready for this, $114 to $119 billion. That is more than analysts were anticipating at about $108 billion. Now we know that $60 to $65 billion of that is Capex that's going to be used for infrastructure. And indeed, they say that's the largest single source of expenses this year. The second highest will be employee compensation as the second largest factor. They say as we add technical talent in the priority areas of infrastructure, monetization, reality labs, generative artificial intelligence, and regulation and compliance. And speaking of regulation and compliance, they also talk about that the regulatory landscape in the EU and the U.S. could impact their business. So I guess the big question is, at different times in its history, we have seen investors be less patient and more patient about them spending money. Up till now, investors were fine, throw $60 billion at Gen AI. We love it, it's okay. Is that patience wearing thin or is it still intact?
It's tricky because, as you mentioned, it goes in cycles. Remember, everybody was excited, and then they overspent on the metaverse, and then no one wanted them to spend money. Now they're spending it on AI, and people are still okay with it. We'll find, we'll find out in the DeepSeek era whether that is the right move or the wrong move. I do think actually the market's giving them a bit of a pass because their AI model is more open source than the others, and so that may actually have proven to have been the way to go, and so the market's okay with it. But again, I still want to see how the market reacts to the guidance because obviously the numbers were such blowouts, and my constant refrain is it's all about the guidance. And the fact that they're withdrawing their guidance for the full year or not offering any is a bit weird. Their first quarter guidance certainly is lower than the market had hoped for, at least on a revenue basis. And so those are the kind of things that maybe no matter how good the current quarter is, that's the forward-looking stuff that might trip up the market.
Yeah.
Go ahead, Julie.
Sorry, just one more thing I wanted to mention here is that in contrast with some of the other Gen AI businesses we're talking about, one of the things that I think we've pretty consistently heard, Josh, from analysts who cover the stock is that Meta is one of the companies that is making money from AI today, that it is getting something of a return on its investment because of its ad technology, et cetera. So, we'll see what discussion there is of that on the call.
And speaking of ads, I mean, we mentioned the top and bottom numbers. Ad revenue also did beat 46.78 billion. She was at 45.65, so a healthy beat there as well. As we discussed, I mean, when Zuckerberg says they're going to drop as much as 65 billion on AI infrastructure projects with DeepSeek AI, that's going to come up on the call. How he's thinking about that and the effect on Capex. Maybe we hit a peak in Capex. We'll see. All right, Microsoft shares sliding as the company misses cloud revenue estimates for the second quarter. Company also reporting it saw 13 percentage points of growth in Azure from AI services. Here with a closer look is Rishi Jaluria, RBC Capital Markets software equity analyst. Rishi, it is always good to see you. Let's dive in these Microsoft numbers here, Rishi. Maybe there was some initial disappointment here in the after hours. Again, we don't have guidance yet. That'll come on the call. The Azure business, Rishi, so 31% revenue gain. That was slower than last quarter's pace. That did just miss at least what your colleagues on the street were looking for. But walk us through the quarter, Rishi.
Yeah, and always a pleasure to be with you, Josh. Appreciate you having me on. Look, I think this was overall a pretty inline quarter with what we expected. Azure was maybe a tiny bit light on a constant currency basis relative to the street and at the low end of where they guided. But at the same time, you also have really strong commercial bookings. You saw the commentary from them that they had really strong OpenAI bookings. And then the AI number was, I think, kind of very, very impressive. I mean, right before this, you were talking about who's actually monetizing AI. Microsoft talked about $13 billion in AI ARR in the quarter, and they had soft guided to $10 billion. So they're ahead of their own expectations, ahead of where the rest of us are. Look, I mean, we don't have the guide yet, and I think that's what the stock action really hinges on, is what do Satya and Amy say in terms of Azure acceleration in the back half of the year. Can they reiterate that re-acceleration? Remember, that's off the first half of the year, not just off Q2. If they can, and they can talk about first-party capacity coming online, meeting AI demand, I think the stock can still be fine coming out of this.
Rishi, I get that $13 billion is a lot of money, but that's the annual run rate, and they just made almost $70 billion this quarter alone. So, it's not a big piece yet, right? Or are there ways that they're monetizing it not directly that are somehow benefiting the business in your view?
I think that is absolutely happening, but remember, we're in such early stages when it comes to AI. If we kind of rewind the clock back and thought about the initial build out of cloud, including Azure, thinking about the initial build out of the internet, you have to spend and invest, and there has to be a discovery of use cases, especially when you're playing from a leadership position like Microsoft is. But having said that, Microsoft's leadership position in AI absolutely influences other businesses in their portfolio. We've talked about this AI halo effect. And so as companies come to Microsoft because of their AI, they come for other parts of the portfolio as well. And Microsoft is able to successfully sell things like Microsoft Fabric, Cosmos DB, even the Office suite. And I think that AI helps indirectly in other places as well.
Hi there. One question I have would be regarding AI, and I'm going to say it, Bing. Does it move the needle at all vis-a-vis Google? I actually, because my company uses Edge and therefore that's the search engine I end up using a lot. I do find it's actually gotten a little bit better. But can they dig into Google's lead in search thanks to some of the improvements in AI?
Look, I would agree with that. We think Bing and overall the Microsoft search ecosystem, whether we call it Bing or Copilot or whatever, we think that can lead to share gains for Microsoft, especially as the share shifts more to unstructured and semantic search rather than just straight keyword search, which is what we're all used to. One thing that I think is really underappreciated around Microsoft is the coup that was hiring of Mustafa Suleyman. By bringing Mustafa in, who was one of the co-founders of Google DeepMind, he really has strong consumer chops, and consumer has been an area where Microsoft has been relatively weakened for a while, but we're already starting to see what Mustafa is bringing in terms of refreshing the app, refreshing the search experience, refreshing even Edge. And absolutely, we think Microsoft can continue to be a share gainer in this space, especially now that Mustafa is at Microsoft.
Rishi, real quick before we let you go, is $80 billion too much?
It's a tough question to answer, right? Because when we debate TAM, or total addressable market of AI, we don't know what that number is, right? It could be 100 billion, it could be in the trillions of dollars, especially if you think about net new use cases and the technological unlock. My kind of answer to this is I trust Microsoft to be diligent with their spending. We've sat down with executives from Microsoft, and they've talked about ways that they're actually measuring ROI on that CapEx. And so this almost becomes look, they need to maintain that leadership position. It's really important to build that out, but we kind of have to trust that they're spending the right amount. And by the way, 80 billion is not where we think it's going to peak. We think fully burdened CapEx will continue to go up from here. But at the same time, and I know we didn't really talk about DeepSeek, as we get this greater advancement in infrastructure efficiency, as Gen AI workloads can be more capital efficient and drive down the cost curve, that's going to be great for AI revenue generation, and that's going to be great for capital efficiency.
Rishi, always great to see you. Thank you for joining us. Appreciate it.
Thank you.
Meta shares rising on earnings. Joining us now is Angelo Zeno, CFRA Research Senior Equity Analyst. Angelo, good to see you. All right, so Meta, now this stock had soared about 70% over the past 12 months heading into this print. Angelo, we're kind of bouncing around here in the after hours right now, basically hugging the flat line, but give us your high-level take, Angelo.
I think the numbers were fantastic, to be honest with you. I mean, for the quarter, obviously, I mean, you're looking at a number of $8.02 versus, I think we're looking at $6.74, growth of 21% year over year. I think we were looking for about 17%. So as far as the quarter is concerned, it was very, very good. And then, I think you kind of look at, the guidance for the quarter ahead. I think, overall it was slightly below the street and where we were looking at, but you also have to take into account there were Forex headwinds that are being accounted for. That was to be expected. I mean, I think you're going to probably see a number of misses from the street in terms of the guidance for the March quarter from a lot of these mega cap names. And you're looking at about a 3 percentage point headwind here for the March quarter. X that, and also mind you, we're going to be lapping the peak growth rate that Meta saw a year ago, which grew 27% in the March quarter of last year. So when you kind of take that all into account on a constant currency basis, you're looking at a growth rate of about 15% or so, which is kind of where we were looking at.
What do you make of expenses for this year of as much as $119 billion, especially given that they didn't give revenue guidance for the full year?
Yeah, I mean, listen, I would normally think that would be alarming, but when you kind of look at the numbers that they just posted in here, and you kind of look at the operating margin number that they threw out there, I think the operating margin was about 48% or so for the December quarter. They are executing absolutely phenomenally right now. So, as far as kind of that expense number here for the full year looking ahead, I think one, they're trying to be a little bit on the conservative side of things. That way they don't have to increase it as the year progresses. I think the other thing here is they're executing so strongly here. The top line growth, it looks extremely good, and the opportunities ahead for them remain extremely compelling. So in our view, we're not extremely concerned about it. But yeah, I mean, at the end of the day, it was a little bit above where we expected. We were personally looking at about 110 billion or so. So it is kind of, let's call it, 6 or 7 billion at the midpoint above where we're looking at.
Question for here, the opposite, of course, of expenses is revenues. And how do you feel about them just sort of punting on the idea of full year guidance on revenues? Obviously the first quarter looks a little light. The market originally reacted to that, and though now it's sort of putting it aside.
Yeah.
To what do you attribute just sort of the idea of saying, sorry, we're not going to give you that guidance anymore?
Yeah, I mean, listen, I think, as far as kind of these mega cap companies are concerned, I mean, most of them have not been giving annual guidance here in recent years. Whether it be Meta, whether it be Microsoft or Alphabet or Apple. I mean, these companies in some instances also aren't even giving numbers for the upcoming quarter. It's just more qualitative in nature. I think that's the case with Alphabet. That's been a concern for many out there, and the fact that they don't kind of provide better kind of clarity in the upcoming quarter. But as far as Meta is concerned, they didn't give full year guidance last year, and they're not giving it this year. The comparisons get absolutely more difficult here for the year ahead in 2025 versus 2024. They had an absolutely phenomenal 2024. So, I do expect their growth rates to come down. I think they can sustain something along the lines of a mid-teens growth rate on a constant currency basis. I think you're going to have a lot of volatility in terms of kind of the dollar is concerned. So I think that could also be another reason why you avoid giving a longer term outlook out there.
Angelo, what about DeepSeek? Meta investors who are listening right now, how should they think about what that new AI model means for their company?
I mean, I think they look like geniuses right now, right? I mean, I think at the end of the day, they when you kind of look at the Mag 7 names out there and who kind of got it right, I mean, the two names I think that kind of stand tall here are really kind of Apple and Meta for different reasons, right? I mean, on Apple's side of things, obviously the fact that they've kind of punted and didn't kind of create their own large language models and instead kind of are outsourcing it, as the cost basis comes down significantly and that business kind of gets commoditized on the large language model side of things. Apple is going to benefit significantly from that. And then on Meta side of things, having kind of that open source platform model and the ability to kind of leverage a lot of these kind of capabilities and models out there, I think will help them kind of monetize AI a lot quicker than others out there maybe had originally anticipated. And I think Llama at this point in time looks very attractive. If you're kind of looking at it, maybe not in 2025, it's not going to improve kind of the ROI in 2025, but as we look into 2026 and 27, there's a massive opportunity out there for Meta.
We shall see. Angelo, thank you so much.
All right, thanks for having me.
And Steve Sosnick, who has been hanging with us for the past hour here. So we have Tesla missing earnings. We have Meta with a disappointing forecast. We have Microsoft missing with Azure. And all of them are turning higher. What's going on?
Traders trade, investors consider. Let's see what happens after we hear the conference calls.
Fair enough.
Wise
and
words,
very
Steve.
succinct.
Wise words. Thank you. That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.